Be well received by this market. Net, you are starting to see futures, like you said, taking a real beating when it comes to the tech space, but S&P futures also fairly low as well.
Yeah, but the earnings story is not a tailwind, it's a headwind, just marginally a headwind for stocks. Right, here we go. It is time for the opening trade here in Europe. We're going to get a picture of what is happening in our part of the world. Remember, Asia, very ugly session. We're pointing to a significant sell-off in tech in the United States as well. Is this just a natural recalibration for these markets as some of the positioning comes in, particularly in tech? There's the opening trade, as you can see. We are soft. We're not that soft yet. Look, we're down by less than 1% on the FTSE 100. We're now down by more than 1% on the FTSE 100. We're expecting, let's call it circa 2% broadly across Europe in terms of the losses that we are likely to see here in Europe this morning. But think about the fact that the Nikkei was down by 12%. It was a really ugly session overnight in Asia. Now, a number of factors are different, obviously, between these two sets of markets. And to a certain extent, there's a currency factor we need to put into the story as well when it comes to Asia. But Europe's down by, let's call it 2%, just shy of 2% this morning. It's ugly, but it's not that ugly yet. So what does that tell us about what we are learning about the nature of this sell-off and what we are seeing sold off and what it tells us about how people's portfolios are positioned? And that tech story in particular, Kriti, how is that unwinding? How is that renormalizing, you could argue, back to maybe something we've seen more historically?
Well, it's no surprise, Guy, that when you look at these opening trades for the FTSE and for the Stoxx 600, it is red across the screen. In fact, brutally so. But there are some pockets of green. I think that's interesting to actually maybe focus in on what's performing well here, because you do have a couple of biotech stocks actually higher this morning and some consumer names as well. I'm curious how much of this shows up as a hedge. For example, let me just walk you through some of them that we're seeing. The Stoxx 600, from an index contribution perspective, that are in the green. Unilever is top of the charts. Then you've got GSK as well. So same with Merck, which I think is an interesting kind of trade to make, given that we are indeed talking about consumer concerns at the core of this entire story. You are seeing a couple of banks as well taking a bit of a beating on the downside. We are getting headlines right now that UBS is halted, down about 6%, but there's a lot going on. Commodities seem to be the one that's taking the biggest brunt in terms of index contribution, but then of course you are seeing, like I said, some of the consumer names in the green as well, Guy.
It's interesting. So the market is just seeking safety. You've gone back into the obvious safety trades. Unilever and Reckitt Bencki's, you've got L'Oreal in the mix, you've got some of the drinks companies in the mix. Interesting to see Bayer actually in the mix as well. This is totally logical in so many ways.
Yeah.
That it's slightly alarming. But understandably, maybe some of the banks are coming under a little bit of pressure. Some of the stocks that have been bid so strongly recently. The FT running a story, I think, over the weekend, asking when the Rolls-Royce rally was going to run out of steam. Well, this morning, that stock is down by, let's call it 6-7%. The stocks that have been really strongly bid recently are understandably the ones that are going to get hit hardest.
Exactly, and I'm curious how long this actually lasts from a pain point of view. When we do kind of see that continued sell-off, is this a one-day thing? Do we see a buyback? When we compare this, and I think a lot of folks are comparing some of the carnage that we've seen to previous crashes in 2022 and 2020, it tends to be the volatility that we keep an eye on. So a big sell-off one day, a big sell-off on the other, and I think the red on the screen you're seeing here is just really, again, the breadth of the sell-off that we are seeing in today's trade. So it's not, again, that surprising from what we've heard.
So the next question becomes, is this orderly and rational, And if so, does it stop in a logical place? I.e., does it not feed back into the real economy? Because if it feeds back into the real economy, this sell-off, then you start to see, as you were pointing out earlier, a financial conditions effect, and that starts maybe to exacerbate concerns on the downside that we get a recession, and it pushes the US into recession. And that's the fear here. Or is this just an orderly reorganization of the markets? Tech got to extremes, starts to come back in again. Some of the banks begin to retrace a little bit as well. Some of the moves that we've seen recently just kind of renormalize.
Well, the latter feels like the easy response, right? In that this is simply just markets being markets. This is traders trading. It's as simple as that. But I want to bring it back to the other argument, which is that maybe fundamentals are actually driving this. You mentioned those recession odds. We look at the 2s-10s curve. It's now inverted again 5 basis points, but it's completely changed. The other, I think, phrase a lot of people have been talking about in the last 3 days or so has been the Somm rule and whether or not it's been triggered. Well, we heard from Claudia Somm herself on whether it's been triggered and what it actually means for this economy. Take a listen.
That puts it up over its 0.5 percentage point threshold, noting that comes off of historical experience. That doesn't necessarily tell us where we are right at this moment, saying a recession. This has seen way too much momentum in the unemployment rate in recent months. I mean, 4.3%. Right? This is not, so whether we are at that moment of a recession or not, this is your build into substantial weakening in the labor market. Again, I don't overread one data point, but this isn't one data point.
Claudia Somm there, chief economist of New Century Advisors, and of course the creator of the Somm rule. Let's get a little bit more context here. Joining us now, Christian Moeller-Glissman, head of asset allocation research over at Goldman Sachs, joining us around the table. A pleasure to have you on the program. Man, did you pick a good day to join us. Look, at the core of this concern, whether you call it market positioning or whatever, is the payrolls report we saw on Friday. Is these concerns about a recession, as Guy and I were just mentioning, are they valid?
Yeah, listen, I think it's been a long time that we had a correction, and I think that's important to keep in mind. And we turned tactically a bit more cautious 3-4 weeks ago, roughly, and there were 3 reasons. I think the first reason was the U.S. economy and generally U.S. data has been weaker, and it's been weaker for 2 months now. This is not the first print we got. Yeah. And the market has treated that as bad news as good news. If anything, we actually saw the S&P futures positioning move more bullish in the last 2 months. So you had this disconnect. Bad news was good news, and the market was actually getting more bullish. That was the first concern we had. Eventually, the Fed buffer cannot be big enough, or the bad news becomes bad news. The second reason was valuation expansion in the tech space. I think last year, the Magnificent Seven, a lot of the performance was actually driven by earnings revisions. This year, a lot by valuations. So our team, David Kostin and so, they were really highlighting this earnings season, high bar to beat. And the third reason was the U.S. election uncertainty picking up. So all of these factors have actually materialized, and they've contributed. But of course, as you were saying, the most important has been the U.S. data weakness. I think the U.S. data weakness has also surprised us a bit. Our economists are not that worried, and we can discuss that. But all in all, I think we're dealing with a correction that, it's a terrible word to use, but it's somewhat healthy. You've had a very strong run this year. Positioning was a bit too bullish. The data picture has been a bit more mixed. We have more election uncertainty coming up. And I think to some extent, it's a healthy correction.
A healthy correction of stocks, perhaps. Is a 70 basis point move in the 10-year, or the 2-year, I should say, either one, pick your metric, they're both down about that. Is that a healthy correction?
I think a bit to what Guy said earlier, I think it's a healthy or rational move, in the sense that the market needs to price now downside convexity into rates. I think before there was a lot of focus on normalization cuts. Normalization cuts are steady, whereas if you have reactive Fed cuts, we know that the Fed has a lot of buffer to potentially cut. You need to put in the probability of very large cuts now. So to some extent, again, it's somewhat rational. But that move, I think, is tough to extrapolate from here with our base case macro outlook, because it really starts to move towards a higher probability of a recession. And to be clear, our economists have increased their probability of a recession. I think they were at 15% just before the weekend, which is the unconditional probability. Now they're at 25%. 25% is still not a shocker. Yeah. I think considering your very late cycle in some regards, that needs to be reflected by the bond market. So it's somewhat rational.
How far away are we from the point where assets start to rotate lower and that feeds back into the economy? at the moment, this is a healthy correction, to use your words, i.e. we get back to a more equilibrium state. How easy is it to put your finger on the point at which we say, actually now this is going to start to affect consumption, this is going to start to affect sentiment, this is going to start to push the ball, the snowball downhill even faster, and it starts to gather a little bit of pace?
I think...
How difficult is it to judge that?
Very tough to judge. I think our economists have obviously their financial conditions model, and you've come from a relatively easy financial conditions level, so there's a bit of a cushion before you really get into terrible contraction territory. But I would say, I think one of the core things that has been interesting about this expansion is you have a very healthy private sector. So there's very few financial imbalances. Normally, the reason why you worry about financial conditions tightening is because it flushes out financial imbalances. You create deleveraging pressure. And you see this in the markets right now. The yen carry trade is a famous imbalance which is currently unwinding. But the question is, do you have financial imbalances in the US economy that are really unwinding in a violent fashion? And what we've been saying is that the private sector in the US is unusually healthy, considering how late cycle you are in some regards. So there hasn't been a lot of re-leveraging in the corporate sector. There hasn't been as much re-leveraging in the consumer sector. What has been the case, though, is that US households have an enormous allocation to equities, the largest household allocation to equities on record, near the tech bubble levels. So the wealth to income ratio has massively expanded. That helps the consumer feel very good about their consumption.
Does that reverse now?
And that is at risk of reversing.
Okay. So if you have wanted to not underperform, you've had to be long tech. So we're now in a position where tech starts to come down. Do I just have to accept, therefore, that I am going to underperform the market at this point, that the S&P is going to underperform the equal weight? What do I do in a portfolio now? I've been chasing returns, I've been chasing performance because I've had to have been in tech. How do I reposition my portfolio? Is it just I go back to a 60-40, I go back to a more diversified portfolio? What do I need to be doing right now and thinking about? I'm not talking about a knee-jerk reaction here, but kind of if the period of tech underperformance is coming to an end, how different does my portfolio look in this new period?
I mean, the first question is, does it really come to an end, or is it a temporary episode? But I think what we've been saying this year, and you might remember this, we've been very bearish on 60-40 for the last few years, 2022, 2023. But this year we said you should go back to 60-40, and we said you should start to think about building a robust 60-40 portfolio. The bond market can help you again. And as we just discussed, the bond market did help you. So I think if you are in a 60-40 portfolio, you're not in a terrible spot in terms of performance right now. Certainly, you've caught up a lot of the underperformance.
Am I going to catch up?
Yeah, you've caught up a lot of the underperformance versus an all-equity portfolio, because there were a lot of people just 3-4 months ago saying, why would you bother with bonds in the first place? So I think 60-40 is not a bad idea. It depends a lot of what you do within the 60 and within the 40. So within the 60, to your question now, should you completely rotate away from tech? I think there's already a large correction, and you need to kind of probably be a bit more discriminate. Some of those business models are still very attractive. I'm not a stock picker, so specific stocks like NVIDIA, they might be more under scrutiny because of the AI capex, but a lot of the tech stocks we know have very solid business models, are cash generative, strong balance sheets, and are actually not as expensive as during the tech bubble. So I think for long-term investors, these stocks might still be very valid. What we've been saying is you want to have a barbell strategy of large-cap quality growth stocks, which might include tech, but there's plenty of other compounders in the world, and you pair that with deep value opportunities that have the ability to re-rate and don't have as much valuation downside. And I think that strategy still stands. But now to your question, what do? You need to rotate a bit more defensive. I think for sure you need to think about defensives in the portfolio. We've been very bullish on healthcare as an example. And one of the styles which has been one of the worst performers in recent years is low volatility. I think you want to think about the low volatility style across the equity complex. It's been a big underperformer, but now with lower rates, because it suffered a bit from leverage, and to some extent focus on growth, low volatility can be a very interesting addition.
So in 2008, not that we're there, but in 2008, the Norwegian Sovereign Wealth Fund bought the bottom of all of these tech stocks. It ended up being one of the most profitable trades, I would argue, in the last decade for a player of that size. Is this just one big green light to buy tech right now? Now that you have this valuation overhang that's kind of disappeared, if you do actually see the carnage carry on to the U.S. session that we're seeing right now, is that what I'm hearing from you? Buy defensives, find the liquidity, find the safe havens. Doesn't tech just check that box?
I don't know. Like, the problem with tech is it's actually a volatile sector. It has high valuations. It has long duration. You pay for future cash flows very far out in the future.
Yeah.
So it's very sensitive to the cost of equity, to equity risk premia. Some of those business models also have disruption threats. There's a lot baked into these valuations. So I think they're definitely not as safe haven as like healthcare.
Yeah.
But I think you're right, depending on how long your time horizon is and how good your stock picking is, picking the right tech business models that actually will, in 10 years, still have significant market share and business opportunities, I think there is probably an opportunity. I would just give one statistic. The average or the median drawdown of the NASDAQ in a calendar year since 1990 is actually 16%. So we're at 11. So far. So we have to be a bit careful because buying the dip is always something you should do in very fast drawdowns, in very large drawdowns. But I wouldn't say that we have seen the median drawdown even. And from that perspective, you need to also be careful to go in too early. But the longer your investment horizon, and the Norwegian government has a very long-term investment horizon,
right,
the more you want to take advantage of these drawdowns, definitely.
Christian, great to see you this morning. Perfect morning to see you. Thanks for stopping by. Christian Müller-Glissman, Head of Asset Allocation Research at Goldman Sachs. Thanks very much indeed. European equities are down, let's call it circa 3% right now. Technology is the lead, loser, banks, energy, also in the mix as well on the downside. Quick look at where we sit with some of the core stocks that we always monitor here in Europe. This is what the picture looks like here. And as you can see, there is some safety being sought, but you're not even finding an area of safety in a stock like Nestle this morning, which is still down by 1.5%. But look elsewhere. Novo, down 5%. LVMH, 2%. Ferrari, 2%. So luxury's doing okay. Tech is definitely where the weakness is. Schneider's in the mix as well. So actually luxury may be a place to hide this morning on a relative trade versus maybe that tech story out of Europe as well. Let's find out what else we're watching this morning. Joe's got plenty of movers. Over to you.
So as expected, Guy, a lot of these single stocks moves just being wiped out by this broader market decline today. And in fact, just 10 stocks on the entire Stock 600 were in the green as I looked at the open of trading this morning. But just on these chips, we're seeing Infineon coming down around 3%. Now, actually, some analysts saying the sales decline wasn't as bad as expected, but still the stock coming lower. There are also separate reports around a potential delay to one of Nvidia's chips overnight as well. But really, the broader market move decline, as you were discussing in the tech sector, weighing on the other chip makers, BE Semi, ASML down now almost 20% over a 3-day period, a massive decline in that stock today. There were a couple of corporate earnings to take a look at as well. There's a few declines. I was seeing a pre-market decline on United Internet. This is the German classified website company, a bit of a sales miss. Company, and also PostNL over in the Dutch postal space. A bit of a positive one on that one finally, but as such, we are seeing declines in most of those earnings companies today. There is some deals news flow to look at as well. Quite a lot going on in that space. We mentioned in Stocks to Watch, SocGen offloading this wealth management unit, potentially 25 billion in assets under management. L'Oreal buying a stake in Galderma. This is a skincare company over in Switzerland, potentially worth around $2 billion, a sizable deal for that one, coming up 2.5%. OCI selling one of their fertilizer businesses based out in Texas. That's a decent deal as well. And John Wood Group going the other way, down 39% as private equity walks away from a takeover of the UK oil engineer. Interestingly, they note recent financial market uncertainty, one of the reasons they are walking away from that one. Aberdeen, meanwhile, not quite getting the boost we thought it might from the FT report on a potential new CEO coming in. The CFO, the temporary CFO, may be taking over that position according to the FT, but the broader market moves wiping out any positive on that one. In terms of morning calls, a couple in the UK today. Lloyds gets a downgrade, this one over at Citi. They're citing the weak net interest margins at the company just around a week ago in their latest earnings report. And finally, we've got a move on United Utilities, underweight over at Barclays. That's interesting to me because the decline in bond yields should be positive for that space. But a lot of utilities in the UK had a recent boost following the election, and Barclays is downgrading a number of firms today. Underweight on that one, and we're down 4% on United Utilities.
All right, Joe Easton there from our equities team, giving us a little bit of a roundup of some of the stocks that are moving in the early trade. Coming up, we're going to dive into one of the sectors he was talking about, Infineon joining a global tech sell-off. This comes, of course, the German chip maker's revenue misses estimates. We're going to break down the details next. Stick with us. This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Morning, Monday the 5th. We're 22 minutes into the equity session here in Europe. This is what it looks like. We're down, let's call it circa 2% in Europe. Tech is down pretty hard. Now, you think about what is happening here. A lot of people, if you've wanted to outperform, you've had to have been long tech. So a lot of people have been long tech. They wanted their portfolios to outperform. They've probably been overweight equities as well, quite significantly. So they don't necessarily have the ballast in their portfolios to protect them from a big downside move in tech. So I think you need to factor that all into your thinking this morning. But Europe is not down that hard relative to the rest of the world. But chip stocks are certainly where we are seeing some weakness, Critty, this morning. And that's totally understandable. This is where those stretched valuations maybe have been most acute.
Well, I'm waiting for whether European chip stocks are on the same page as American chip stocks, because in the lead up to the sell-off and then going into last week, and I would argue last couple of weeks, you've seen that a lot of the options volatility has actually showed up in Intel, in Micron, et cetera. And I was waiting for kind of the read-through into Europe. And I didn't get one last week, but I might have gotten one this morning. Joining us now, Bloomberg Daybreak Europe anchor Tom McKenzie, all over the story. Is Infineon the poster child this morning, or is it kind of doing its own thing?
Infineon is a reminder that those chip companies, those semiconductor companies that are really have that exposure to kind of the cyclical movements of this global economy and the industrial space are much more sensitive in this environment. Look, this is a broad-based route, of course, across the semiconductors, but Infineon's sales dropping more than expected, the margins coming in lower than expected. They have particular exposure, and this has been a concern for a long time for Nvidia, their overexposure to the automakers, the OEMs in Asia as well, in South Korea and Japan. And as those companies pull back on their build-out and their supply of electric vehicles, then Infineon was going to be impacted. And that's what's come through so far. So that is the question for Infineon going forward. On the AI story, they just have 1%. They have a bit of exposure to AI, but only 1% of their revenues come from AI-related chips. This is all about the industrial play. It's all about EVs. It's about there's a
so this tells me nothing about
and
Nvidia.
Rising inventories.
So this tells me nothing about Nvidia.
I think you can put it to one side. I mean, Nvidia, again, we saw this from the earnings story again last week in terms of the CEOs and executives coming out and not walking back back their investment plan. Does that change? I don't know. We've got them on record committing to that capex, not just this year, but through to 2025 as well. We heard that from the CEO and the CFO of Amazon, reiterating that, from Meta, from Microsoft. And who wins in that environment? It's Nvidia, and AMD is coming through with a bit of catch-up. They still have a long way to go. So I do think you can put them into different buckets and different baskets, because Infineon is not just sensitive to the slowing demand for EVs, but also to the cyclical elements. If we get into a recession territory, the inventory build-up's already there, and they look a little vulnerable at this point.
Talk to us about the inventory buildups, though. I mean, one of the big questions, maybe not now, but in 6 months' time, is how much of this sector is subject to subsidies on both sides of the Atlantic, even in Europe, where Infineon and other EV makers may be getting more of those green subsidies. Does that matter right now?
The subsidy element is one that possibly could be an impact. Look, we're seeing, of course, that massive fund push that's coming through in terms of the US to build out the foundries. Intel has been a beneficiary of that, and yet, of course, it had that record drop last week because of the cost still, even with those subsidies, of kind of building out that foundation or foundry play for them, which is a massive gamble, of course, by Pat Gelsinger and co. In terms of what's happening in other parts of this chip market, Samsung was a reminder as well, in terms of their earnings, that in terms of premium, so premium smartphones, that segment's holding up quite well, but it's the more commoditized part of the smartphone market where there's still that softness. So again, you have to break these into different categories. The premium end, so the iPhone 16, possibly that is going to lead to some upsides from Samsung in terms of the supply of chips to those smartphone makers. But in terms of the mid-range and mid-end smartphones, there's still some softness there, and there's still an inventory challenge.
A fascinating dynamic that you're seeing in the chip space. We're going to leave it there. Bloomberg Daybreak Europe anchor Tom McKenzie walking us through when the earnings meets the geopolitics meets a broader market sell-off. I don't even know what is driving the trade, and then you have to factor in things like geopolitics as a part of all of this.
Yeah, we're going to talk about what is happening in Israel in just a moment. I just want to come back. The bond market story, we haven't talked about it a great deal this morning. The market's pricing in aggressive Fed rate cuts within a week, which feels very extreme to me. Like 114 print, is that going to take us in that direction? Maybe geopolitics is another factor we haven't kind of spent enough time talking about this morning. We're waiting for a response out of Hezbollah. We're waiting for a response potentially out of Iran. We're looking potentially for a imminent strike. That's what Axios is reporting. So we're going to find out what that could potentially mean in terms of the market reaction that we're getting this morning. Axios is reporting it could come within hours. We'll talk about it more in a moment. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
This is the opening trade. We're about 30 minutes into today's session. You are seeing red across the screen on really all around the world. You saw it in Asian stocks. You're seeing the read-through into European stocks. Your underperformance right here, but it's really that tech pain that you're seeing. NASDAQ futures kind of paring back some of those losses, but still down 4.5% in the States. And of course, chips really taking the brunt of the hit this morning when it comes to those European stocks as well. Another sector I don't think we've given enough focus on is going to be the commodity sector, because that's also where, especially when it comes to the FTSE, you are seeing a lot of the pain when it comes to the sell-off. And a lot of that's just magnifying the move you're seeing in commodities as well. Oil right now trading at a 76 handle for Brent crude. You're seeing NYMEX at about 73 handle. That spread between the two narrowing down to, we'll just call it $3 and change, if you will. And that is all as pricing not only just the risk sentiment, but the geopolitics coming out of the Middle East as well, where Israel is bracing for a possible attack in retaliation for the assassinations of Hezbollah and Hamas officials, while the U.S. continues to press for a ceasefire deal. Now, yesterday, G7 foreign ministers expressed concern about the risk of a wider regional crisis during a video call. A lot of developments, a fast-moving story. Let's get more perspective. Bloomberg Jumana Bersetchi joins us now from Dubai this morning. Jumana, walk us through what we learned this weekend.
Yes, well, what we learned is that an attack certainly does appear to be imminent. The U.S. Secretary of State Anthony Blinken held a call with his counterparts from the G7, Axios reporting that he told them to expect an attack on Israel from Iran and its proxies, be they Hezbollah and Houthis, in a matter of 24 to 48 hours. This at the same time as he called for an urgent de-escalation of tensions in the region. But we also know that the U.S. Central Command chief, that is the General Michael Kurilla, arrived to the Middle East region on Saturday. He is expected to try to shore up regional and international support, a coalition, so to speak, to support Israel's air defense system, similar to what happened back on April the 13th. You may recall that Iran direct attack onto Israel, unprecedented in nature. More than 200 missiles were sent towards Israel, but they were intercepted by this coalition. And so the U.S. Central Command chief is there to try to shore up support for a similar coalition to be put in place. This, as we know, is the U.S. is also sending further military ships, fighter jets to the region. Some airlines have suspended travel into and out of Tel Aviv, the likes of Air France, KLM, and British Airways suspending travel. Embassies in Lebanon advising their citizens to leave the country as soon as possible, including U.S., France, UK, Australia, and more recently Saudi Arabia and Turkey as well. And so the entire region is bracing for something to happen in the next 24 to 48 hours.
Is this a regional conflict? Is this the wider war we have feared? Talk us through that. Is this a catalyst to maybe get a ceasefire in Gaza? Talk us through the implications, if this attack comes, of what it's going to mean.
Well, Guy, we've been speaking to many analysts from the region, experts who have been in the region for decades, and many people say that this is the most heated moment the Middle East has seen in years, and namely because we're not just talking about one specific touch point or hot point. We're talking about various fronts being opened up. And you speak of the likes of the Ayatollah, the supreme leader, Khamenei, saying that they want to retaliate on after the assassination of that senior Hamas leader within Tehran, embarrassing for their own security. You talk about Hezbollah chief commander Hassan Nasrallah last week delivering a speech where he vowed vengeance, saying that this war has moved on to multiple fronts. We continually monitor those Houthi attacks on vessels going through the Red Sea. And so there are many fronts opening up here, and it certainly does appear to be the case that all of those proxies are preparing some form of retaliation. The risk of a misstep is very high. At the same time, we know that the U.S. are continually pushing for a progress on those ceasefire discussions. So if there is going to be a release valve, it will probably be in the form of getting a truce over the line. But at this point, there are still a lot of stumbling blocks. And even though the fact that Israeli delegation went to Egypt over the weekend to make some breakthrough on those talks, there was no progress. They came back early. The two sides seem to be far apart. Israel are saying that they don't want to move on from phase 1 to phase 2, i.e. from a truce to a permanent ceasefire until they have completely neutralized Hamas. And they're also insisting on control of a corridor around the Philadelphia corridor on that Egypt-Gaza border crossing. Hamas are saying, or whoever is left from Hamas negotiating team are saying that they will not accept the terms of a ceasefire until they have reassurance that it will lead to a permanent end to the war. So again, a lot of daylight, but the U.S. seem to want to keep pushing for that ceasefire as the only way of bringing down the tension in the region right now.
Jumana, thank you very much indeed. Jumana Basechi joining us out of Dubai on what is happening. We're going to keep a careful eye on the news flow over the next few hours as we anticipate this retaliation. We'll bring you the news if and when it comes. Let's talk about the implications of the story for commodities. Oil is the obvious kind of route through this story, but actually this morning in some ways not a big reaction, as Crude's been talking about already this morning. We're down by 0.2%, not a big move to the downside. Joining us now, Angelina Valavina, head of the Natural Resources and Commodities team, EMEA Corporates at Fitch Ratings. Angelina, thank you very much indeed for your time. Look, we are seeing a sell-off in a number of assets this morning. It's interesting that energy stocks are under pressure as well in the mix. Why are energy stocks not a good place to hide in this kind of environment? Is this the kind of environment where we could see further downside because of the recession fears that increasingly appear to be growing?
Good morning, and thank you for having me on the program. Yes, you're absolutely right. So on the one hand, there is a geopolitical risk premium, which is an important component in the commodities prices, especially in the oil and gas prices. On the other hand, there are concerns about the moderating global economic growth, moderating Chinese demand growth for oil, which serves as a lead or as a cap on the oil prices. So if we look at the geopolitics, this risk does increase the prices, but the impact remains temporary, adding to volatility in the prices. So far, there have been no major interruptions to oil production or oil flow despite the tensions in the Middle East, and this underpins the supply side. Having said that, large spare capacity at OPEC+, rising supply, and as mentioned before, moderating demand growth keep pushing the prices below the $80 per barrel for Brent, as you've shown before on the screen. So on the demand side, we expect demand growth to moderate to below 1 million barrels per day for this year, compared to our previous forecast, marginally above 1 million barrels per day. The key contributors to this revision are weaker Chinese growth, demand growth for oil, concerns about the pace of the global economic growth, and efficiency gains.
Yep.
On the supply side, supply is continuing to grow, and as I mentioned, there is a huge OPEC+ spare capacity.
Okay, that doesn't sound great if I'm an oil major. So what do I do? What do you see in stocks like BP and Shell, both of which are down this morning? BP's down by 2.5%. Shell is down by 3.5%. draw a line between the stories you've just been describing and what happens with some of these stock stories here in Europe, which so many people rely on for income. How stable are they?
So I run the natural resources team at Fitch Ratings. So we're a credit rating agency, and as such, we're looking at the credit profiles of the companies. But given that there is a cap on the growth in the oil prices, but at the same time, the geopolitical risk, the modest growth and demand provide support and the floor to the oil prices, they still remain quite healthy. So we forecast the oil price for Brent at $80 per barrel. Therefore, the results, let's say for the oil majors like Shell or BP, were quite good in the first half of this year. And they were in line with our expectations. They were largely in line with the market expectations. And that obviously is reflected in the market dynamics and potentially in the stock prices for these companies.
Angelina, that all makes sense. And let's do it through the lens of the credit space, as you suggest. If we see some of these big oil majors being these kind of high yield, chunkier, yield driving kind of assets that people add into their portfolios, how much of the U.S. shale supply matters to this story? How much of it cushions that geopolitical risk that you were just outlining?
To some extent, because if we look at the global supply growth, this year it's relatively modest. It's lower than 1 million barrels per day. But next year, we expect the supply growth to be well above 1 million barrels per day, around 2 million barrels per day. And most of the supply growth will come from the U.S., partially from Canada and Brazil as well. So U.S. production growth is an important component of the supply growth. Having said that, the spare production capacity at OPEC Plus, which is well above 5 million barrels per day, is a much more significant cushion for the supply if there is any physical supply disruption due to the tensions in the Middle East. This is much more significant cushion, and this is what provides a constraint on the magnitude and longevity in the oil price increases.
Angelina, just as we speak to you, we are getting headlines out of Iran. The foreign ministry spokesperson, Nasser Kanani, speaking in Tehran. And I just want to bring you these headlines here. He says no one has the right to tell Iran not to punish violations. Also saying we have the right to punish Israel in the framework of international law. Again, these are some of the comments we largely expected from the foreign ministry itself. But Angelina, for our global audience here, break down where that pressure comes from. Because when we talk about Iranian supply in this market and the read-through from geopolitical risk, a lot of the analysis has come from American sanctions on Iranian oil rather than Iranian output itself. Is that still the narrative here?
So the Iranian oil production and supply to the global market is probably of less of an importance in terms of the overall global supply. The key risk here is geopolitics and potential disruptions to the physical production of oil in the Middle East or to the supply of the oil in the Middle East. So, for example, if the conflict affects the Strait of Hormuz, where a large chunk of the oil supplies or oil flows is going, then there may be repercussions for the market and there may be repercussions for the oil prices.
Okay, that would be a very extreme situation.
Correct.
How big a tail risk is that right now?
So it's about 20% of the global seaborne oil flows are going through the Strait of Hormuz. So if there are significant disruptions and they're relatively lengthy, then obviously the impact will be quite substantial. But as I mentioned, again, we have a 5.8 or 5.7 million barrels per day of the spare capacity at OPEC Plus, and then there may be some redirection of the global oil supply. But having said that, there will be an impact on the oil prices, and there will be a high geopolitical risk premium for that.
How much volatility do you think we're going to expect in the oil space? You've laid out, you've got competing scenarios. You've got the economic slowdown in the States, the global economic slowdown, plus the geopolitics on the other hand. Are we just going to basically oscillate between one fear and the other fear? And both of those fears are going to drag prices in different directions. So are we setting ourselves up for big swings in energy prices?
So far, the swings were quite muted, around $5 per barrel. So the price is hovering between 80 to 85. If there is a significant escalation, then these swings might be much bigger. It can be $10 per barrel. It can be $15 per barrel. But I don't think that they will be protracted in terms of the time frame. because again, there is supply, there is spare capacity in the market, and the supply side is managed by OPEC because quite a few million barrels of oil per day were removed from the market by OPEC. And if these barrels are coming to the market, then this will balance the market. But the swings might be quite bigger than their current.
But Angelina, is that a dislocation? Is that something that the oil market, oil traders are getting wrong? And I bring you the stat here. Is last week when we had these developments from Israel, the attacks in Lebanon, and not to mention in Iran as well, oil only rallied about 2%. And if you put that in a standard deviation alongside all of the geopolitical kind of spikes we've seen, traditionally that spike looks like 4 or 5% in the oil price. You said it perfectly there, which is that this isn't as big of a reaction as we would traditionally get. Why not? Is that a mistake from the market?
I don't think it's a mistake. I think it's a supply and demand balance because the market started realizing that the supply side is managed. There is overcapacity, but then the demand side, albeit demand is growing, it is growing at a moderating pace. So even before we expected the growth of over 1 million barrels per day, as I mentioned before, now we expected it below 1 million barrels per day, which is quite a muted growth. It's below the average for the last, let's say, 10 years, which was marginally above 1 million barrels per day. It's mainly because there is a slowdown in the China. In addition to that, we shouldn't forget about efficiency gains, and we shouldn't forget about the energy transition, which effectively means that in the longer term, the demand for oil will structurally change, and it will be slower.
Certainly a lot to digest. Angelina Valavina, head of the Natural Resources and Commodities team in EMEA Corporates over at Fitch Ratings. We thank you so much. We're continuing to get headlines coming out of Iran as well. Of course, it's coming from the Foreign Ministry spokesperson. Iran is saying they're not looking to escalate tensions in the region, whereas previously they had, of course, said they have the right to defend according to international law. We'll bring you all the headlines as we get them. But coming up on the program, European stocks continue to drop along with NASDAQ 100 futures, kind of parrying some of those losses, but still down over 4%. We're going to dive more into this market route next. Stick with us. This is Bloomberg.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So, yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
This is the opening trade. We're about 30 minutes into today's session. You were seeing red across the screen from the equity markets. Arguably some weakness that you were seeing in the European, well, like it looks like the European currency had moved back, but weakness in the dollar, as I think we'll call it. This all seems to have come, at least in part, from some of the sell-off you saw over in Asia. And a big chunk of that is what we saw in the yen as well. We're looking at dollar yen at a 143 handle. It did drop as low as 142 as well, pairing some of that initial move, but still pretty significant from the 150 that we were at last week. At the same time, we are just now getting headlines from the Japanese finance minister as well, Nichi Suzuki, speaking as well, commenting, or lack thereof, about whether the current FX levels are indeed sudden. She says they can't comment on whether they reflect the fundamentals, but they are indeed going to be watching those moves. Let's get a little bit more insight here on where we go in the FX space. Markets Live executive editor Mark Cudmore joins the program this morning. Mark, we talked a lot about the sell-off, a lot about the fact that tech may be in the States driving this. What happens next for dollar yen?
I think dollar yen still has some more downside. I think we're in a little bit of a trader's market at the moment. So there's a bit of momentum. There's still a bit of positioning clean out to happen. I am in the camp that at some point when this moves stabilize, I think yen will start weakening again. The fact is, it still has deeply negative real yields that must remain deeply negative because Japan cannot afford positive real yields because the economy is too stagnant and can't sustain its debt pile without those deeply negative real yields. And that means that when things calm down, when we've finished cleaning out these positions, whenever that happens, the yen will still be the obvious, funder out there. It'll still be the trade to shorten. So I think that at some point it is time for the yen to depreciate again. Is that going to happen imminently? No, probably not, because I think the route we've seen today will have spillover for the days and even weeks ahead, and therefore we have more pain to come.
Mark, is what we're seeing Friday, this morning, out of Asia into Europe, potentially into the United States, is this a rational move? As you say, clearing out of positions, there's been some leverage, tech is taking the biggest hit. Does it just end there? Does it stabilize? Is this something that kind of naturally works its way out? The story fizzles out eventually? Or is this something that has the potential to start driving further moves, i.e., we get it to the point where it starts to affect the economy, where we start to see maybe the Fed having to take action, emergency action, to deal with the downside that we're seeing in risk assets? How finely balanced is this at the moment? Where are we now? Where could we go?
Yeah, it definitely has the potential, and it is very finely balanced. I think it's a great question, guys. Like, where are we? I would say that, if we recover quickly, I think the economy will be fine, and I think we'll move on from this. But at the moment, there are a lot of panicked people out there, and if these moves sustain, you have a material wealth impact. At the moment, that negative wealth impact is mainly paper wealth, and it doesn't really see that real economic impact unless it sustains. So I do think it's finely balanced, but, I always worry about the saying irrational, because the market is always right. But it does seem like these sudden repricings don't tally with the economic inputs, the fundamentals we've seen going in. It seems weird that we've got such a significantly different view of the world than we had this day a month ago. And that seems awry. Yes, things may have been expensive and exuberant before, but now we've gone to sheer panic, and that seems wrong. Now, obviously, your instinct when I say things like that is like, well, surely it's time to buy the dip. Everyone knows the mantra, the investment mantra, buy when others are panicking. However, if you look at the history of Japanese stock markets, they've basically had 5 precedents in history where they've sold off this powerfully, this quickly over a few days. And that is the March 2020 COVID panic. It is February 2016 when we were worried about China and global growth. It is 2011 tsunami. It is October 2008 post-Lehman. And it is October 1987 in Black Friday. And only one of those times did the Japanese stock market not go on to make further lows in the months ahead. And that was the March 2020 panic, where COVID panic, where we basically had unprecedented combination of fiscal and monetary policy response. And I just don't see that happening a week after the BOJ just hiked rates. So I think there's unfortunately more downside to come. And therefore, I am worried about the potential for this to become a real economic impact, even though it's not my base case at the moment.
To that point, Critty, I can't yet get my arms around whether or not Friday was an anomaly. Was the data that came out of the United States an anomaly? Was it weather related? Did the hurricane have a big effect? Was that data not telling us the true story of what is happening in the United States? Claudia Sam was talking to Bloomberg Friday. She was saying it's not just that piece of data. There are other pieces of data, but it feels like that piece of data, the non-farm payroll number, has been a catalyst. And if the signal from it is erroneous, then maybe the market reaction is wrong as well.
There is a sensitivity to downside data that is almost asymmetrical right now. And I think this comes back to 2 months ago when we had poor CPI prints, poor PPI prints, and it seemed like that whole set of data pointed to some sort of slowdown, and then it kind of revamped in some of the inflation data as well. But the market took off.
The market didn't slow down during that period.
No, it saw it as a sign of confidence that things were happening. But that was the point where you say that was one data point. And now you're saying, okay, well, these are a couple to Claudia Sam's point. But from an investment point of view, Mark, I want to bring you back into the conversation here. When it comes to kind of hedging some of this concern, whether it's recession or whether it's fear of a sell-off or a flash crash, whatever we end up calling this in retrospect, where do Japanese assets fit into that equation at a time, or I want to say just like a month ago, when JGBs, the yen, Japanese banks, served as a hedge in a lot of people's portfolios? Is that still the case after this carnage?
No, I think it's slightly different. It's a great question, because obviously at times this portfolio management is what decides the winners from the losers, right? Because the temporary long-term fundamentals go out the window. And obviously when you're getting into this panic, as we discussed earlier, people are going to be out there looking to buy panicked and oversold assets. But I don't think Japanese stocks are where those attempts to buy the dip will prove most fruitful. So I think other stock markets will gain. I don't think Japanese stocks are going to come back in vogue that quickly. I think JGBs are still problematic, but I don't think they're going to suddenly be a panicked asset. And as I said, even though I think the yen can be a depreciation story again, it's not yet. It's too soon to get excited about trading those long-term negative fundamentals in the yen. The fact is, even though we might have cleaned out a lot of the weak hands, the short-term players, there's a massive overhang of structural yen shorts out there via funding of long-term structural notes. Many of those notes are going to be owned by like private high net worth individuals that won't even know about their losses for another month or two. So the consequences of this will take a real long time to feed out. And I think it's only a couple of months from now that you start kind of getting excited about the long-term yen depreciation trade again.
Yeah, maybe they'll have worked their way through the volatility, and private markets will do what they're supposed to do, which is not to market instantaneously, and you don't have to deal with the volatility. Mark, great stuff. Thank you as ever. Some great coverage coming up. MLIV Go is the function you are definitely going to want to plug into your Bloomberg terminal this morning. I don't know. This morning is fascinating. To Mark's point, it's about you're seeing some position clear out. You are certainly seeing that. That's really clear. Japan is an obvious place to look. In a few minutes' time, 4 minutes' time, we're going to start to get early pricing on some of the US tech stocks. What are they going to tell us about how the session is likely to progress?
And how does that ripple effect to the other assets, right? Because if you start to see a sell-off in stocks, does that then accelerate the bid into bonds, accelerate the bid into dollars? You're 100% right that this is all going to shake out in a second. I still have my eye on dollar yen, though, and I still have my eye on the FX space, because I think it's fascinating that even in the space of that, you're seeing strength in euro dollar right now. You've seen strength in cable off the back of a worldwide market panic.
Absolutely. Okay. The Pulse is coming up next. Francine is going to be taking you through the next hour. You are at the top of the hour going to get pricing on NVIDIA, Apple, post the Buffett selling. All of that is coming up. We're going to continue to monitor what has already been a turbulent morning and is likely to continue to be as we count down to the US Open. So some fascinating moves in the next few minutes. Francine is going to take you through all of that. The Pulse is coming up next. It's been a busy morning. Thanks for watching. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Could face bigger challenges next.
Was going to keep reading World Cup. This is a 3
As the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The global market sell-off deepens into European trading after Japan's Nikkei crashes more than 12%, while traders increase bets on the Fed making an emergency rate cut. Nasdaq futures tumble as investors pull further away from the AI rally. Warren Buffett also cuts his stake in Apple by almost 50% in the second quarter. And Israel is on high alert. The country is bracing for retaliation from Hezbollah and Iran. Axios is reporting the attack could come within hours. Now let's take a look at the European markets map, because there is quite a lot going on because of this market rout. Now that started in the U.S. on Friday after the jobs report. That, of course, filtered through Asia. I think we have the topics and some of the Nikkei stocks at the lowest in about 7-8 years. And then you can see the FTSE, the CAC 40, also the DAX down some 2.3%. Now let's also look at what that means for U.S. futures. There has been a rotation back into bonds because there's now market pricing that the Fed has just been behind the curve in actually trying to adjust interest rates. So S&P futures down 2.3%. NASDAQ will be spending a good amount of time this week looking at, of course, some of these tech stocks. This is not only a Warren Buffett story with a lot of investors, or, of course, Apple saying to a lot of investors to not panic, but this is also a story of AI, so it'll be interesting to see where NVIDIA opens up in just a couple of minutes. This is a picture, also Bitcoin down 52.7%. I've also seen an even bigger rout when it comes to Ether. Now, Berkshire Hathaway, as we were saying, has cut its stake in Apple by almost 50% as part of a massive selling spree in the second quarter. What's interesting is that Buffett is now, Warren Buffett is now actually at about 270 billion, I think, in cash. Apple on the back of that, this is pre-market, down 6.6%. So for the conversations that matter, the markets and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So this global sell-off is intensifying as concerns grow that the Fed is behind the curve with support for a slowing U.S. economy. Now, shares in Asia-Pacific had the steepest slide in 4 years. The topics and the Nikkei indices in Japan falling over 12%. So Bloomberg's Justina Lee is here with me in the studio. Joining us from Zurich is also Nanette Hechler-Feiderb, Head of Investment Strategy, Sustainability and Research, and Chief Investment Officer of EMEA Renee at Lombard Odier. So thank you both for joining us. Nanette, let's start with you. I mean, this seems like a big round because they're worried about AI. They're worried, markets are worried that the Fed is actually late to the curve, but there's also geopolitics, and then earnings have not been so good. What do you worry about the most?
I think at the moment the market is really reassessing its expectations. It was an all-weather, all is well type of sentiment for the last 6 months, and right now there is a level playing. So I think for now we are quite comfortable to stick to strategic asset allocations in investment strategy. It means no overweight, no underweight of equities overall. There is obviously a shake-off right now, which is favoring more defensive sectors and investment themes. And as far as fixed income is concerned, I mean, right now we have gone also from pricing basically no or very few interest rate cuts by the Fed to more than 100 basis points by now, by the end of the year. And that as well seems a little bit exaggerated after just one labor market report that was really below expectations.
Thank you, Nanette. Justina, it feels more than just a labor report. I think the fact that Warren Buffett actually cut his investments to AI and Apple by so much is also making people very nervous when it comes to tech.
Yeah, I think the sell-off really was exacerbated by how stretched the opposite side of the trade was. Like, for a long time, everyone was pretty confident about the soft landing, so people were going long tech. You know, they were putting on these carry trades. They were selling volatility. And I think it just shows how quickly these narratives can be upended. And I think it kind of began with the U.S. jobs report last week. And because of how stretched these trades already were, when they started unwinding, I mean, it just like kept snowballing. And that is why we get such a big sell-off.
Nanette, when are you expecting global markets after the pretty intense rattling? I'm also looking at Japanese bond yields tumbling the most since 1999, which of course is hurting banks. When are you expecting for this to level off or at least stabilize?
I think we have now a few weeks until basically the next labor market report and indeed the September Fed meeting where the market is going to be nervous. Let's not forget that there is a very complicated geopolitical situation as well, and the VIX has soared after a long period of very subdued VIX levels. So I think we are in a risk-off mode probably for a few more weeks until the market gets soothing economic data again. I don't think that the US is really poised for a recession. I mean, manufacturing has been very weak in the US, not only last month, it's been for a stretch of time. And for these few weeks, I expect a lot of volatility in the markets for sure.
Justina, are you expecting more investors to go to cash?
Yeah, I think for now that is what a lot of them will do. But one good thing about the sell-off is at least bonds are doing what they're meant to do. You know, bond yields are falling across the board. So at least you have that hedging your portfolio. And part of that is, of course, tied to Fed expectations. At least Fed has some place to cut from right now. And so you're starting to see markets pricing in, you know, maybe even a rate cut before the next meeting.
This, but was this a due correction, or do you think this is a panic sell-off?
I think there is a lot that is related to sentiment. I mean, Warren Buffett was mentioned. He is very well followed by so many, and there is really a lot of sentiment play, even in markets outside of equities. You mentioned the Bitcoin route as well. I think for sure that on the tech side, there is going to be opportunities as well. The artificial intelligence spread out of its applications to so many sectors is only at the beginning. And I do expect that when some of the negative factors of influence for the market in geopolitics, in the US economy and Fed expectations get clearer, the market has again potential to recover, including in technology stocks as well.
What's your take on, you know, when you look at the various regions, it feels like it's a massive global sell-off. I mean, Japan is particularly hurt because they're also in this very delicate situation, just, you know, the policy that they've just announced. Again, could that take longer to stabilize than other parts of the world?
Yeah, I think that's a great question. I mean, especially since a lot of regions are especially kind of exposed to the cyclicality of economic growth, and I think you're really seeing that right now. I mean, in the case of Japan, I think a lot of that was also exacerbated by kind of this like self-fulfilling prophecy there. You know, you have a lot of retail selling, you kind of have a lot of margin positions being threatened. The carry trade with the yen is unwinding. And of course, with bond yields plunging, I mean, that's threatening the profits of a lot of the banks. And so I think in Japan, you kind of have an especially delicate picture here. They've rallied a lot. But I think a lot of places will end up being even more exposed to a potential U.S. downturn than actually a lot of the big U.S. tech stocks, I think.
Nanette, one of the things that I know you wrote in your notes of course, the rout is the fact that lagging regions or sectors could play catch-up. Is that now delayed, or actually does it get accelerated because of pressures elsewhere?
No, I think it really gets accelerated right now because some of these laggards tend to also be the defensive sectors and regions. I mean, among regions that we have been quite positive on, for example, the UK has been a laggard and is one of these more defensive, less volatile regional markets. Also having some sectors well represented like energy that tend to be high dividend paying. So at the moment, these laggards that at the same time offer defensive market qualities, and if on top of them offer some attractive dividends, are likely to be outperforming at this moment of just simply resetting the base in equity markets.
Nanette, can I also ask about geopolitics? Because I was just at the press conference from the Bank of England governor on Thursday, and he seemed to suggest that actually that tailwind from higher oil prices, from geopolitics that were very uncertain, has been taken off, which is why he seemed a little bit closer to cutting interest rates. Is this now back with a vengeance, or is it, again, part of the narrative that we're seeing a global market rout, and so people also focus on geopolitics?
Yeah, I think it's one of these typical summer storms where everything is gathering at the same time for the moment. Certainly, geopolitical risks are likely to get oil prices rather supported, especially because right now it's the Middle East that is in the eye of the storm. And as such, I would expect some of these tailwinds to come up again, as you say, are likely to be back, perhaps with a vengeance here, and giving support to the sector as well as to regions exposed to them.
Justina, if you look at crypto, and again, we're looking at NASDAQ 100 futures tumbling as this mega cap tech sell-off seems to deepen. But what's the role here of cryptos?
Yeah, it's kind of funny. I think today is a reminder that crypto, even for now, is still kind of pretty tethered to global risk sentiment. I mean, you actually see gold kind of rallying today, but digital gold is not really holding up. And I think it kind of speaks to this relationship that we've seen kind of in the past year, where it's, at the end of the day, pretty related to the riskiest assets. And I think that is, again, a reminder of that.
Justina, thank you so much. Justina Lee, and we'll have more from Nanette Heshler-Faidab from Lombard Odier very, very shortly. Now, coming up, Berkshire Hathaway slashes its stake in Apple as tech stocks take a beating. We'll have plenty more on that next, and this is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
So Berkshire Hathaway has slashed its stake in Apple by almost half. Now, it comes as part of a massive second quarter selling spree that actually boosted Warren Buffett's cash pile to a record $277 billion. Now, let's get more from Bloomberg Daybreak Europe anchor Tom McKenzie. I mean, Tom, 50% is a big deal. So they were kind of, batten down the hatches, trying to reassure investors. But what does it signal?
It is a big deal. So $75 billion sold. They still have a stake of around $84 billion. They had a stake of around 140. So from 140 to 84 billion, it is still Berkshire Hathaway's biggest single stock holding. So that's the context. What does it signal depends on, I guess, your sentiment right now. A lot of people are looking at fear just around every corner, of course, given what the markets are doing. So for some, the take from this move by Berkshire Hathaway and Warren Buffett will be that he is seeing concern around the US economy, that this is a recession call from Berkshire Hathaway. He hasn't made a comment, of course, on the back of this. Other people would say, look, this is about risk management. Given the size of this holding in the Berkshire Hathaway portfolio, this is just a sensible readjustment in terms of their portfolio, or it's something to do with tax. And he suggested and nodded to that back in the early part of this year when he adjusted this holding in Apple. He's previously spoken very highly of this company. We're looking for them to come through with this upgrade, and we saw that from the earnings call last week. They think there's going to be an iPhone upgrade on the back of implementing some of their AI towards the end of this year. But it has left people guessing, and of course it's fed into the fear that we're seeing across the tech sector right now.
I mean, it feels like the perfect storm. So again, timing here is everything. So you have the Fed, you have concerns about a recession, you have geopolitics, you have earnings that weren't great, and then tech. Are we likely to hear from Warren Buffett?
Yeah, so the timing is absolutely crucial, isn't it? It's just landed at the worst possible time for this tech market, given that the NASDAQ fell into correction, of course, to correction territory by the end of the close on Friday. We're seeing what's happened now. We're close to that circuit breaker in terms of the moves lower in the NASDAQ futures today. Apple, the last time I checked, was down around 6% in the futures. Nvidia's taking a big hit as well. So will we hear from Warren Buffett? He doesn't usually talk about these particular positions until it comes to their call, their meetings, their AGMs. So it seems unlikely. This is a trade that's done pretty well, very well for Warren Buffett, Berkshire Hathaway. The stock is up 900% since they first got exposure to Apple back in 2016. But for some, again, if you combine it with the moves to reduce their position around Bank of America last week, and now this sizable cut in Apple, then it does and has fed into this concern that we're seeing across these markets.
Tom, thank you so much. Tom McKenzie there, Bloomberg Daybreak Europe anchor. Now let's return to Nanette Heschel-Feider, Chief Investment Officer for EMEA and Head of Investment Strategy, Sustainability and Research at Lombard Odier. Nanette, when you look at some of, the tech stocks, I don't know how you play them given the huge rout that we've seen. Is this a good entry point for some of the more expensive stock, or do you just wait and see?
I think we are not in a rush to get in there, but the general story about the technological progress that we are seeing, and by progress, I really mean the different waves that we have seen in technology. After digitalization, then the learning models, and now the application of artificial intelligence to so many sectors, especially in services. I think overall, people will look back to that episode as an interesting one to get in, but in no rush to take action here and now because of the broader context, Francine. We can still have a couple of more weeks of volatility here where the technology sector and other cyclical sectors just simply get repriced as people are trying to gauge the risks of recession in the US for one, and then generally speaking, the next moves on the geopolitical scene as well. So no rush here, but in general, still a conviction that technology is part of our future and very broadly applied in so many sectors.
Nanette, there's this pretty extraordinary story that's doing quite well on the Bloomberg, saying that basically traders are pricing in a 60% chance of a 25 basis points Fed rate cut within a week. Now, this would be an emergency rate cut. Is that likely? What signal would that send markets?
I think that would send really a bad signal for markets. If the Federal Reserve was to do an intermeeting rate cut, it would signal a sense of urgency that would continue to just feed that negative sentiment and the wall of worries. I think right now it may be more plausible to expect that actually at the September meeting there would be a larger than previously expected rate cut, 50 basis points, for example, and that is probably where we would be leaning rather than towards an intermeeting one.
So, Nanette, what happens if there's a 50 basis point cut in September? What happens after that? And of course, in the next couple of weeks, we also have Jackson Hole that will really kind of, cement their ideas and their thinking on this market route.
I think, generally speaking, the Fed continues to be data-driven. And, the labor market report this month has been subject to noise. We know that there are seasonal patterns, but then also there has been weather-related influence on the labor market report. So I could very well envisage that the next labor market report actually takes away some of that noise and helps clarify the picture. I think it would probably point towards more rate cuts to come, even if the Fed was to deliver a 50 basis point cut instead of the previously anticipated 25 in September. There is another one to expect in December and potentially more in 2025. So for bonds, I think the general sense is that short-term interest rates continue to fall and continue to feed the normalization of yield curves in the U.S.
Nanette, thank you so much for joining us. Nanette Heshna-Fider up there from Lombard Odier. Now, coming up, we talk geopolitics. Israel braces for retaliatory attacks after the assassination of Hezbollah and Hamas leaders. We'll have the latest from the Middle East next, and this is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology. the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Well, Israel is bracing for attacks in retaliation for assassinating Hezbollah and Hamas leaders as the U.S. presses for a ceasefire deal. Well, Bloomberg Horizon's Middle East and Africa anchor Jumana Bersace joins us now. So, Jumana, if you look at the developments over the weekend, they've definitely escalated. And good morning.
Good morning. Yes, an attack certainly does appear to be imminent, Francine. The U.S. Secretary of State Antony Blinken had a call with his G7 foreign minister counterparts, and Axios are reporting that he told them that they are expecting Iran and its proxies to launch a direct attack on Israel within the next 24 hours. This as the U.S. continues to deploy extra military warships to the region, fighter jets. The Central Command General is also in the region as well, looking to shore up more regional and international support, similar to what happened back on April the 13th, when you will recall there was a direct attack on Israel from Iran's part back then, but pretty much all of those missiles got intercepted because that air defense system and the coalition was in place. They're looking to replicate something similar. However, just in the last 20 minutes or so, we've heard from the Iranian Foreign Ministry, a spokesperson, saying that Iran is not looking to escalate tensions in the region, but that Iran will take serious measures to create necessary deterrence against Israel. So the question here is Iran looking to escalate tensions, or are they looking to create deterrence? That being said, the region is on edge. Many embassies are advising their citizens in Lebanon to evacuate, to leave the country, including the likes of UK, US, Australia, Canada, Saudi Arabia, Turkey as well. And then many airlines have also suspended flights into and outside of Beirut and Tel Aviv.
Jumana, thank you so much. Jumana Bersace there with, of course, a very complete update on what's going on in the Middle East. Now, coming up, we'll speak exclusively to the chief executive of Nova Holdings, which manages the assets of the Novo Nordisk Foundation. That's coming up next, and this is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. The global market sell-off deepens into European trading after Japan's Nikkei crashes more than 12%, while traders increasing bets on the Fed making an emergency rate cut. NASDAQ futures tumble as investors pull further away from the AI rally. Warren Buffett also cuts his stake in Apple by almost 50% in the second quarter. And Israel is on high alert. The country is bracing for retaliation from Hezbollah and Iran. Axios is reporting the attack could come within hours. So let's have a look at what some of the big tech companies are doing. Now, it's only 20 minutes that we've had pre-market, for example, from Apple, but also NVIDIA. This is one of the biggest stories of the day. But let me just put a little bit of context into all of this. It was last Friday that we had a jobs report that was much worse than expected. That sent a bit of panic, saying that actually the Fed was a little bit late to the game. And then this was exacerbated by Warren Buffett saying that he was going to cash. He has about $270 billion in cash right now, pulling away by 50% from his Apple investment. Now, what that means is there's also a concern about AI and some of the valuations in some of these big tech. So this global stock sell-off deepening on growing concerns about the U.S. economy, markets really adding to bets that central bank will cut rates. I think there's now priced in a 60% chance that the Fed cuts in the next 6 days. And then you can see that's putting a really big pressure on Microsoft. This is pre-market, down 3.5%. Meta, Tesla, also down between 4.8 and 5%. I think if you look at NVIDIA, for example, that stock pre-market down as much as 9.6%. I'm also looking at Apple down 6%. So there's just a lot going on. It's geopolitics, of course, with worried about retaliation. It's what we're seeing in AI stocks. And then earnings in general, I have to say, we were looking at some data this morning with the team about what the S&P 500 companies have reported. They're just not great when it comes to revenue. So let's get more on all of this with our Bloomberg Markets live executive editor, Mark Hudmer. Mark, so happy to have you on the show. Look, this is like a global stock market sell-off. We're seeing especially Japan really being sold off. At least, I guess, there's a reaction function with bonds behaving the way they're supposed to. Is that a glimmer of hope?
That is certainly one positive factor. I'm very impressed, Fran, that you've managed to find the one market's positive on a day like this. But you're right, 60-40 portfolios are performing better. And that's a big change from a year ago when we had a sell-off and it was bonds and stocks tumbled at the same time and caused such kind of angst for so many funds out there. Bonds are doing what they're meant to. They're working as a hedge. Now, up until Friday, in fact, this 60-40 portfolio was doing okay year to date, despite the losses last week. I suspect that after today's stock move, 60-40 portfolios are also underwater. But yes, at least bonds and stocks so far are trading in opposite directions, and that certainly helps lower the volatility of those 60-40 bond managers.
So, Mark, do you think this is a healthy correction, or at least a correction, or is this like a perfect storm because Warren Buffett sold out his stake, so there are questions about AI, there's worries about the U.S. economy, there's, of course, worries about geopolitics, and earnings haven't been that great?
Anyone who is trading in a stock market today does not think this is healthy. It might turn out to be called healthy after the fact in terms of it cleans out weak hands, it makes prices a little bit better. But we have just seen the most violent Japanese stock market sell-off ever, if you put it on the pace of losses over 3 days. I was trading at Lehman Brothers into the financial crisis when Lehman Brothers went bankrupt. I was at Nomura. I believe that's Japan's biggest equity brokerage during the tsunami in 2011. I have never seen Japanese stock markets like I have today. So this is not healthy at all. No, the moves right out there we're seeing are really extraordinary. They're causing a lot of pain. It is one of those very, very rare days where I am absolutely delighted that I have no ability to trade anymore or have any risk, because this is a very, very painful market. Even if you're on the right side of it, it is extremely stressful in terms of portfolio management, managing your stops, making sure the winners you do have don't turn into losses, and managing that combination. As you talked about, their bonds are working as a hedge, but they're working in different kind of momentum, different pace, different speeds, slightly different time spans, and how you manage those losers against those winners makes it extremely stressful. So as I said, anyone who's trading today does not find this healthy.
Mark, when you look at Fed expectations, I mean, I'm quite surprised there's a 60% chance being priced in now by traders that the Fed cuts 25 basis points this week. I mean, this would be an emergency rate cut. Would that sow even more panic?
It probably would, but I think we're seeing panic out there already. So I think, actually, no. I think I'm gonna change my answer there and say no. The panic probably won't be much panic because we've got the panic, and so therefore this would be the Fed reacting to the panic. And in fact, it might kind of go, hey, the Fed's always got our back. Let's pump up stocks again. Let's buy everything. Let's buy the dip because they're going to keep on printing money and pump up assets. So I think that, you know what, we won't get too much of an extra panic if the Fed does cut. That said, I don't see the Fed cutting this week because the economy in the US is slowing down. There have been definite cracks recently. It did not look like the data is pointing to an imminent recession or an imminent hard landing. There is certainly a slowdown, but a slowdown from pretty solid levels. Now, there's a risk that the financial markets become a key fundamental for the economy. And our colleague Simon White's done an excellent macroscope column on this, talking about the Fed may be forced to react soon to stop markets becoming a real drag in the economy. But we're not quite at that level just yet. That requires the panic sustaining for a bit longer because many parts of the economy don't mark to market on every basis. We're right in the middle of it. So we see every single pip, we see every single move, and it seems really panicky every moment. But for lots of people, they're not going to see how bad the losses are for another month, for another few weeks, and that's when you start seeing the real economic impact.
Yeah. Mark, thank you so much. Bloomberg Markets Live executive editor there, Mark Codmore. He's not hiding under his desk, but he's leading a big team trying to figure out what is going on in the markets. Now, against all the volatility, the owner of Europe's most valuable company has set its sights on investing big in the green transition. Now, Novo Holdings owns a controlling stake of pharma giant Novo Nordisk. It manages the assets of the Novo Nordisk Foundation, one of the world's largest philanthropic enterprise foundations. At the end of last year, the company had almost 150 billion euros of assets under management. And joining us now is Kasim Kutay, the chief executive of Novo Holdings. Kasim, thank you so much for joining us.
Pleasure,
what a day
Francine.
to be on.
I know, what a day to be on.
We've been trying to arrange this interview for quite some time. So away from the market volatility, there's also a couple of things when it comes to U.S. politics. Yes. When it comes to elections. Here in the U.K., we have a change of government. Sure. How overall do you think that changes the landscape for healthcare?
Look, I think the secular, very powerful secular tailwinds for healthcare should hold us in good stead. And the most powerful one, of course, is the innovation that's taking place in the sector now. We are seeing, and you've heard me say this before, we are in a golden era of innovation. So actually, if you recall, when we had the biotech correction and the IPO markets were shut in the middle of 2023, we said, look, the IPO markets will reopen. Companies will be able to go public again. And this is exactly what happened, because at the end of the day, the innovation is so powerful, and we're seeing unmet medical needs tackled in a way that they haven't been historically, that has really put a floor on valuation. And indeed, what we've seen over the last 6 months is management teams, companies with late-stage quality data are going public, are raising funds. So actually, yes, of course, politics has an impact, pricing has an impact, but at the end of the day, the fundamentals, aging populations, growing middle classes in emerging markets, unparalleled levels of innovation should hold the sector in good stead.
Can you give me a sense of what you're most excited about? So I know there's been a lot of talk about prevention, and this is you know, the next frontier. The problem with prevention is that you pay a lot up front. You pay a lot up front. Prevention is critical. I think there's almost a there's an economic and there's a moral argument for prevention. The economic, of course, is it just costs much less to prevent rather than to treat. And the moral one, of course, is that we're able, if you can treat people earlier, then you avoid the acute issues that arise with serious treatment, and indeed you save lives. And the imperative is higher today than ever before, just simply because what's available to us. So if you look at where diagnostics is today in terms of its ability to diagnose earlier and more accurately, and you look at the therapeutic interventions and options that we have today that we didn't have 10 years ago, it really means that moving and having a paradigm shift in our healthcare systems from really a system that's geared to treatment to prevention is going to be important. And frankly, I don't know how we're going to sustain the healthcare budgets that we have unless we move to a more preventative model. But the problem is that it's upfront, it's quite costly. So is there a country that will lead the way in showing the right model for it, especially at a time where budgets of a lot of countries are extremely stretched because of the debt burden? Yeah, I mean, I think interestingly, the most interesting examples that I have seen of prevention are in some of the smaller advanced countries. So Singapore has done a fantastic job, and the Emirates, I was there not long ago, fascinated by the amount of investment they're putting up front in order to diagnose and treat earlier, and therefore avoid all the costs, both financial and to lives, that comes from ignoring prevention. What's your take on what's happening in the UK? Again, we have a new government, freshly in charge for I think we're coming up to exactly the 1 month anniversary. Yeah. They have a huge problem of NHS on their hands. Sure. How do they recalibrate? Yeah, look, I think first of all, broadly speaking, this government, the current government, is very focused on the life sciences, which is terrific because they have a very strong growth agenda, as you well know. And you're not going to grow the UK economy to its full potential without growing life sciences. It's the second largest industry in the country, so there's a very strong recognition. But you're absolutely right. I mean, the industry and the NHS are intertwined. And if you don't deal with a lot of the issues with the NHS, the UK will lose some of its leadership positions as a life science powerhouse. And I'll give you one key example. The UK is one of the leading destinations for clinical trials. You want to do clinical trials here as a pharma company for a host of reasons. The UK has consistently been a leader in Europe as a clinical trial destination. It's still a leader, but that leadership position has eroded. Why? Because the NHS is in the situation it's in, absolutely stretched, and an inability to work with industry in order to conduct clinical trials. So absolutely dealing with the NHS, particularly the waiting list, first and foremost, to get to that reset, and then take things from there. So I'm hopeful, and the government and Wes Streeting have been very clear about the need to reform and about the need to deal with the waiting list. So let's wait and see. Obviously, easier said than done. The issues are enormous. I have a couple of questions on green, but also AI. So sure. Maybe we start with AI. Does that change clinical trials or the way that we develop, treat, and pay for at the end of the day?
Yes.
A lot of these
Technology has a big role to play in healthcare in multiple ways, and we're very heavily invested in that. The whole interface between tech, AI, biopharma is a very interesting space. And of course, there will be efficiencies from the use of AI. It's incredible. Much of the healthcare industry, particularly if you look at the UK, you look at the US as analog, it's actually quite staggering. Stuff is on paper still. And forget AI. I need basic technology adoption. So
and we heard about computers that don't even link.
The computers that don't even link. I mean, it truly is analog. I mean, there's just such a long way to go, and AI would be icing on the cake. But where AI is also interesting is not in making technology and AI, not just in making our systems more efficient and productive, but they have a profound impact on drug discovery and indeed on diagnosis. And when we're talking about budgets and staff shortages, etc., the ability to use AI to enhance a physician's capabilities to diagnose and to triage patients is going to be a very powerful trend.
Talk to me about green investments, which, you know, again, in this political cycle, I have to say companies, but also big, you know, charities are a little bit more cautious about talking about green investment to see where the needle lands.
Yeah, we're not cautious at all. We're very bullish. We're very focused. I was actually reading I was reading the GIC from Singapore, the annual report there, and read the CEO's shareholder letter, and he expressed what I regard as our sentiments, which is, look, the direction of travel is unquestionable. There'll be bumps on the road, there'll be puts and takes, but ultimately we all know where we're headed. And if you're a long-term investor, it is a very, very interesting place to be. So we are absolutely full on, and we're going to take green investing from about 2% of our portfolio up to 10% by the end of the decade. We just announced a few weeks ago a very interesting investment in the UK. I don't know if you saw that, CircTech, which does recycling for end-of-life cycle tires. So if you are able to stay the course long-term, but importantly, invest in these companies as they scale, because that scaling often is what takes a long time, then I think the end rewards will be there. And certainly we are firm believers in that, both on the bio-industrial side and on the classic sort of green tech side.
So interesting. Thank you so much for joining us. That was, of course, Kasim Kutay, the chief executive of Novo Holdings. And maybe we should catch up in a couple of months to see how that investment is also going.
With great pleasure. Anytime, Francine. Thanks for having me.
Thank you so much for coming on. Coming up, the UK Prime Minister, Keir Starmer, calls on an emergency security meeting after far-right riots rocked several parts of the UK. So we'll have all of the details next. And this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Welcome back, everyone. The UK Prime Minister, Keir Starmer, has called an emergency security meeting in a bid to quell far-right riots that have rocked communities across the UK. Now, violence erupted in towns and cities over the weekend in the first major test for the new Labour government. The disorder has been fueled by an online misinformation campaign since an attack a week ago left 3 young girls dead.
I utterly condemn the far-right thuggery we've seen this weekend. Be in no doubt, those that have participated in this violence will face the full force of the law. I guarantee you will regret taking part in this disorder, whether directly or those whipping up this action online and then running away themselves.
Well, let's bring in Bloomberg's EMEA News Director, Rosalind Matheson. So, Ros, what exactly has sparked the violence?
Well, they're both long-running factors and new factors that are really behind this, but it goes beyond what we saw a week ago with the terrible deaths of those children in Southport, the knife violence that happened there. And the UK has grappled with these issues like other countries for many years, the debate around migrants, asylum seekers, Islamophobia, and how to manage those in a society that's complex and fast-moving. And just like other countries, it's been an issue here. You can see it going back prior to Brexit. Brexit was billed as an effort to sort of put the migration debate to bed. It's only really fanned it in a way. We've only seen it become even more into the public discourse in recent years. We've seen some attacks on politicians. Now we have this, and we've seen that sort of colliding into the events of Southport. We're seeing disinformation being propagated, as you say. Part of that might also be these right-wing groups using this disinformation to try and pressure the new government. Of course, we just saw Labour come in after many years of Tory rule, so perhaps these groups want to put Keir Starmer, the Prime Minister, under some pressure. Like, how's he going to handle this situation? How's he going to manage it? How's he going to contain it, if at all? And so it's really an effort to also test him quite early in the piece.
So, Ros, how has the government responded in the UK, and actually how can they tackle misinformation?
Well, as you heard, he's come out pretty strongly and said we're going to deal with that. He was, of course, a chief prosecutor back in some London riots in 2011, where he was also managing that process. We saw the riots that spread across London in the wake of the shooting of a black man back in 2011. So he's using that playbook again, which is get the courts moving pretty quickly, get these people who've been arrested in front of courts, try and contain it by putting a legal net around people, getting more police out onto the streets, because these groups are saying they plan more incidents, more moments. They're trying to keep things going. But beyond that, even if you get, 300 people in one place and they stop coming out, it's obviously still bubbling away in society. And that's a much more complex thing to tackle. How do you deal with this structurally in society?
Ros, on the U.S. side, when do we have Kamala Harris actually picking her VP running mate?
Well, imminently, we hope, because she's supposed to be on the road this week with her vice president pick, campaigning, and they said they want this knitted off also by August 7, so today, tomorrow, quite possibly. We know from sources that she was meeting some of the members on the shortlist yesterday. That seems again to be around a number of senators and governors, including Josh Shapiro from Pennsylvania, of course, Mark Kelly, the senator from Arizona. What these shortlist all has in common is that they're white, they're male, and they're sort of centrist in the Democrat camp, and they say there's a balance for her, because some of the attacks that are coming already on her are saying that she's a California liberal, that she's very, very radical in the Democrat Party. Whether that's legitimate or not, that's the attack line that's coming. And so this can balance her out, particularly in swing states. But then, of course, she has to be on the road with this vice presidential pick, and they have to do proper campaigning, and that's going to test her a bit.
Ros, thank you so much for the update, both in the UK and the US. Rosalind Matheson there. Now, coming up, Europe's most valuable companies among the major firms due to report earnings this week. So we'll have a full roundup of not only the rout, but earnings. This is Bloomberg.
This is Bloomberg News Now. News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Connection lost.
Well, Europe's most valuable company is among some of the biggest firms in healthcare, manufacturing, and travel reporting earnings this week. Tim Craighead, Director of Research at Bloomberg Intelligence, joins us now. Tim, thank you for joining us. Given the massive rout that we're seeing, where do earnings play into this?
Yeah, well, while I think that there is reason to be looking ahead and this too shall pass for lots of things, earnings are not necessarily one of those supportive factors. We have seen beats outpace misses, but growth expectations for the second half have come down a couple of percentage points. We have seen some negative revision to forward numbers as we look out to 2025. So earnings, they're okay, but they're not great.
So what can you tell us about what are the big earnings that you're watching for this week that could give us an indication where the market's heading?
Yeah, I think there are two key things to look at. One is you mentioned Novo Nordisk, Europe's largest company. You've also got Eli Lilly in the U.S. They are the competitors in the diabetes, anti-obesity area of GLP-1. It'll be really interesting seeing not only how their sales are going, but how their supply constraints are, which has been holding the market back versus much larger demand. The other area to watch, I think, is the U.S. consumer, because we start to see some of the retailers reporting. We've got Costco, Yum Brands, which is KFC, Pizza Hut. You've also got Disney that reports. And those touchstones in terms of U.S. consumer sentiment and how they're feeling, and importantly what the CEOs are saying, I think is going to be a pretty strong guiding light.
Yeah, it will be, especially as the markets, I think traders are pressing a 60% chance of an emergency rate cut, 25 basis points from the Fed. Tim, thank you so much. As always, Tim Craighead, Director of Equity Research for Bloomberg Intelligence. Very quickly, we've seen a massive global stocks rout. So let's have a look at big tech pre-market here in Europe. So this is pre-market. You can see Apple 7.8% lower. I'm also looking at Alphabet and Nvidia down 9%. Up next, more on the markets with Bloomberg Brief with Manus Cranney in New York. This is Bloomberg.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges was elected.
Was going to keep winning World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Good morning from our global headquarters in New York. I'm Menace Cranny. It is Bloomberg Brief. Let's set that agenda. A global crisis of confidence and in growth, and the Fed stokes a dramatic repricing of rates. Traders now betting a 60% chance of an emergency Fed cut within a week. A tech implosion. NASDAQ futures rebound from a 6.5% drop after entering a technical correction on Friday. This as Berkshire Hathaway bails on Apple. And the yen rally intensifies as carry trades unwind. JGBs fall the most since 1999 as the Topix enters a bear market territory. A very good morning to you. What you have is a crisis of confidence manifest in the growth story and the Fed, and that takes your cross-global equity narrative lower. Nowhere more visceral has it been than in Japan as the yen rallies. But to the NASDAQ, down 3.8%, we had dropped by nearly 6.5% at one juncture. We're now at such a tipping point of where fear is overcoming greed that the market is now pricing in a 60% chance of a 25 basis point, that is an intra-Fed cut. 60% possibility of an intra-Fed cut. Apple is down 7.6%. Berkshire Hathaway guts their position in Apple by 50%. The last time, I should just put some context around this, SPOOs are down 2.4%. The last time you had an intra-Fed meeting cut was in March 2020 in COVID. It was a total of 150 basis points with QE. So the narrative has pivoted very aggressively from no landing to a hard landing, very aggressively. Nvidia is down 20% from its peak. The question you must debate for equities is whether this is an air pocket and an opportunity or something much more toxic than that. To the bond market, let me show you what's going on there. 10-year government bonds dropped by over 40 basis points last week, but the short end of the curve, you haven't seen this scale of repricing. Just to put some context around it, down another 7 basis points this morning. That is down a total of more than 60 basis points in 6 trading sessions. This is the fastest implosion of the short end of the curve behind headline rates since 2008. This is a hellish hard landing the bond market is going for. You might be bullish on bonds, but these are nervous bulls on the bonds, and the yen and Swiss, the haven status of those currencies, is affirmed in totality. How long will that endure? Peter Kinsella is my guest this morning, Global Head of FX Strategy at Union Bancaire Privée. Peter, good morning to you. Good to have you with me. As you look at these markets, you could be forgiven for saying there's a sense of mania, there is a sense of panic in terms of the growth confidence and the Fed being behind the curve. How manic a Monday is it for you?
Yeah, it's as manic a Monday as they get. The last time I saw these type of moves, in dollar yen was pretty much in 2008, in terms of the speed and magnitude and breadth that we're seeing. So it's a manic Monday, no question about it. What we've seen certainly in dollar yen, I think last week was really interesting in the sense that with the BOJ obviously raising rates, engaging in aggressive sort of tapering of its QE program. But I think the fact that the BOJ said they were likely to raise rates again in the subsequent meetings pretty much indicates that the BOJ believes that sort of growth potential in Japan is probably a lot higher than many had anticipated before. And then obviously we've seen a very aggressive sort of rewind in carry trades, people getting out of long positions in Mex and Brazil and others. And likewise, you're seeing dollar yen pretty much fall like a stone. We've gone in the space of 2 weeks from 161 all the way down to sort of 142 as of this morning. So it's a very, very aggressive move, mainly a short covering move. And I think if we look at sort of the broader dollar, really what we're starting to see, obviously dollar weakness against the safe haven currencies such as yen and the franc, we're now likely to see that sort of widen and broaden, and I think certainly we're likely to see the dollar weakening in a more directional manner against the likes of the euro, sterling, and so on. So it's really a case where we're seeing the first leg against safe haven currencies, and next against some of the other majors in G10, and thereafter we'll have to see what the Fed's doing.
Okay, let's just put a pause in there because there's a lot to unpack. Let's start with the narrative. The market is now vaulted from, on Friday morning when I started this show, I said there was a nano chance of an intra-Fed rate cut. Now, the last time we had an intra-Fed rate cut was in March. It was in the March 2020. It was in the eye of COVID. It was 150 basis points. Differentiate for me now between COVID 150 basis point cut in March 2020 and now the baying call for an intra-Fed cut, 60% probability. Do you agree that it could come, and if so, what size and scale?
Okay, do I agree whether it will come? I would say probably not. I think that it's unlikely in my view. What we're seeing at present is quite simply, it's not, what we're seeing in COVID is not a crisis. It's simply a business cycle, right? And I think the moves you've seen overnight in Japan likely exacerbated by very poor liquidity. Let's not forget that. And certainly if the Fed simply signals that it's likely to cut rates aggressively in the coming months, that should do the trick. They don't necessarily need to cut rates this week, as it were. So I'm not yet in the camp where we'll see an aggressive rate cut, intra-meeting cut. I think that would be really sending panic signals to the market.
And by the way, the first intra-Fed meeting cut in March 2020, Peter, invoked a drop of 3% in the S&P 500 and rates to go 1%. So it was a crisis response mechanism that we saw there. Okay, let's move it forward. So the Fed have got to jawbone the market to create the floor, as it were. I haven't seen, if you think about dollar yen, it was parabolic on the way up, Peter, wasn't it, in terms of the dollar's ascent? Here it is, it's almost like a bottomless pit at the moment. And I want to clarify from you, if you say leg one is short covering, do we go towards a capitulation move of where we trade through? The next leg is to trade through the 140 level and over 142.40 at the moment. So is the next leg, if we are genuinely in a growth slowdown phase, a business cycle growth slowdown phase, do we continue to buy yen, or is the alternative to buy Swiss and perhaps do some more unwinding of the carry?
I think it's likely, yeah. I think we'll go through once, getting a move below 140 is definitely feasible. I mean, if we look at dollar yen, a fair value in dollar yen, probably closer to 120-ish, maybe 125. So there's definitely more juice in the trade. I think the move we've seen thus far is really, really positioning shift. But if we look at it in terms of monetary drivers, that will be the next leg. And certainly with a slightly higher rate from the BOJ and indeed lower rates from the Fed, that's likely to push dollar-yen that little bit lower. I think that down move will certainly be less volatile than we've seen and less abrupt. But nonetheless, I think the direction of travel is lower. The carry trade really that we've seen in the last several years, it's burst. Many of us for a very long time were saying that yen was, absurdly cheap. And certainly that's now unwound, and this process is going to be a multi-month process. It's not going to be something that's done and dusted in a week, I'm afraid.
What do you get from the Fed this week? Is it a jawboning?
Oh yeah, I would think so. I think if they were to cut this week, in an intra-meeting cut, it would really signal panic stations from my perspective. So I think that's just a step too far. But certainly, moving towards, the Jackson Hole Symposium at the end of the month, I would anticipate we'll get very, very strong signaling from the Fed, at which they say, look, September, done deal. Consider 50, and then perhaps we'll see how we go from there. But an intermeeting cut at this point, we're not dealing with a pandemic. We're dealing with a simple reversal of a business cycle, and so to my mind, an intermeeting cut would be unjustified.
Yeah, well, as I say, in March 2020, the first response mechanism was to crash bond yields and equities. The second move, of course, put a floor under it, Peter, that cut off 100 basis points. Mm-hmm. Does this give then additional drumbeat to the doves on the Bank of England and within the ECB? I'm just looking at euro sterling at the moment. She's flying higher, cable's a little bit lower, nothing too dramatic, down by 1/3 of 1%. I think that's got a touch of geopolitics in it as well. A reality check for Keir Starmer on the finances and one thing and another. Down 1/3 of 1% is where we are on cable. Does this kind of mania of risk off, which is how I would describe the equity market and the bond market, Peter, is quite literally fraught this morning. I would say bullish, but fraught. Does it add to the narrative of cuts for the ECB and the BOE?
I would say it does. Look, I mean, where the Fed goes, the others follow, right? And certainly vis-a-vis, the BOE in particular, they've got a very, very close business cycle. What you tend to find is that their respective rate moves move pretty much in tandem, albeit with small lags. I think from the BOE's perspective, they could have remained on hold last week, and in a sense, the Fed should have cut, right? So, they basically, we could have seen a role reversal there. But nonetheless, I think if we look at the BOE, they've signaled they're going to continue cutting rates. 5-year swaps in the UK at around 3.7, 3.6%. So it kind of tells me we're likely to get a front-loaded rate-cutting cycle here in the UK. I think 100 basis points in the next, 6 to 9 months is feasible for the BOE. I don't think they're going to do a lot more than that. Certainly, that was the message we got from Haskell, from the BOE's Haskell. So overall, look, I think that we can anticipate further rate cuts. From the majors. It's a question of speed and timing, of course. But as I said, look, where the Fed goes, others will follow.
Well, Suzuki was on the tape this morning, and again, I think we're possibly, for whatever parabolic moves you had on the upside, I think they're going to be uncomfortable as well with the velocity of the strength. Peter, thank you very much for the context this Monday morning. Peter Kinsella there, Union Bancaire Privée. Other stories trending on your Bloomberg terminal this Monday morning. L'Oréal is buying 10% of Galderma. Now, this is a Swiss maker of injectable skin fillers. The stake, which has a market value of nearly $2 billion, the French beauty company agreed to form a specific partnership with Galderma to create a new skincare product to reduce the signs of aging, while a recent boom in skincare cools. Vice President Kamala Harris has met with at least 3 possible running mates on Sunday. The shortlist included Arizona Senator Mark Kelly, Pennsylvania Governor Josh Shapiro, Minnesota Governor Tim Walz, and others who Harris didn't speak with in person, according to people familiar with her plans. CrowdStrike says the leadership of Delta failed to respond to an offer for assistance in the wake of last month's catastrophic global system failure that led to thousands of cancelled flights. Delta didn't respond to CrowdStrike's letter, but flagged an earlier reference to taking legal action related to lost revenue, compensation to passengers, and reputational impact. Okay, this sell-off is quite brutal on the equity market. We've got money flowing into bonds at quite a pace. But this is the crypto world. Bitcoin down 11%. We dropped as much as 14% at one juncture. And that's rippling across the family of crypto. It's one of the worst drops we've seen since March 2021. Now, it's the biggest weekly fall, by the way, since the FTX crisis. We're seeing money flow out of these funds, which takes us to the exchanges, all under pressure this morning. Coinbase coming back from its a little bit of a worse drop, down 11.3% at the moment. But perhaps the most brutal of all is Marathon there, down 14.6%, followed by CleanSpot. That is your crypto spillover on this risk-off Monday. Coming up, bad news is piling up in mega cap tech. We put some context around the tech sell-off. And later this hour, we speak to Freedom Capital's Jay Woods on the intensifying global sell-off. Context matters every day on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It is Bloomberg Brief this Monday morning, live from New York. It's been a brutal risk-off across all markets, but especially in tech. Nasdaq futures, but rebounding. I mean, we had dropped as much as 6.5%. That's after the index entered a correction on Friday. As you can see, we have a drop in NVIDIA of over 9%. Berkshire Hathaway has, well, it's got Warren Buffett bailing on Apple. Let's take the broader theme to Tom McKenzie. Tom, I'm looking at what Julian Emmanuel is writing about these markets from Evercore this morning. Corrections are normal in bull markets. They're called air pockets. And they happened often in the internet boom of 1995 to 2000. 2024's AI air pocket is an opportunity to gain exposure in the long run. Well, I tell you what, if you're sitting long of NVIDIA this morning, you might not just see it as an air pocket. It's down 20% from its highs.
Yeah.
How brutal is this? What's the feeling at home in London?
Yeah, and look, comparisons with the dot-com bubble send shivers down the spines of many, of course, and there's the pushback from those who remain constructive on this whole AI theme, saying the fundamentals are very different. And it's interesting to reflect on what we heard from the CEOs last week in terms of on the earnings front, whether it was from Meta or Amazon or Microsoft. One of the reasons why those stocks were challenged and the narrative was challenged precisely because they continue to reiterate they will continue to spend on AI hardware, of which NVIDIA, of course, remains a key beneficiary. Nonetheless, as you're saying, they're pointing to significant additional losses today. Across the market then, you are in correction territory right now for the NASDAQ 100. The drop of more than 10% then since the record highs of July. You talked about the fact that we were close to that circuit break level now. We're far away from that, it seems, right now, but still pointing to considerable losses. The Asian session was pronounced in terms of the losses that came through. Yeah. The banking space was hit, but also the semiconductors. Think of TSMC. The biggest drop that came through there in terms of the market drop for the TAIEX, and TSMC was central to that. The biggest drop, the worst day for the Taiwanese market since 1967, Manus. So this is concerned the valuation risk, concentration risk, politics as well as we lead up to that election, of course, in November. And all of this coming together to provide these headwinds for this sector.
I'll give you a clue, Tom. 1967 was a pretty vintage year. Some pretty important people were born that year. If you look at SPLC, you can restrain yourself now. You look at SPLC, the supply chain around Apple, Tom. It plays to that narrative. The biggest suppliers into Apple also under pressure. Taiwan Semiconductors, Murata Manufacturing, all of these play into the Apple, which then takes us back to the story of Berkshire Hathaway bailing on or gutting their position on Apple. Put that in context for us, because he's not exactly bailing on Apple completely, but it's called a material change in exposure.
Well, the timing is consequential, isn't it? There's no evidence that Warren Buffett or Berkshire Hathaway timed this, of course, to align with the drop that we've seen in the markets. But in terms of, for those investors looking for fear around every corner, this is a further concern. We don't know the rationale. Look, this could be around rebalancing the portfolio. It could be around risk management. To your point, this remains the largest single holding for Berkshire Hathaway. It remains the largest single holding. They've been exposed to Apple since 2016. They've seen an upside in terms of the shares since then of around 900%. So they remain sitting pretty. But this was a big sell down, $75 billion or so from around $140 billion. So their holding remains at around $85 billion. Or so. So it's a significant sell down. Does it suggest that Warren Buffett is seeing concerns? Is it suggesting he's seeing concerns in terms of the health of the US economy? Is it a further risk radar move in terms of anyone who's betting on a recession now in the US? Or is it just rebalancing because it has such a sizable hold within that portfolio? That debate, of course, continues. But bad news in terms of Apple. Wedbush, by the way, Dan Ives saying, look, the fundamentals are still there for Apple. We're looking at that upgrade cycle with AI comes to the fore. That's one view, at least, from Dan Ives.
Tom, thank you very much. Tom McKenzie there with the very latest on the sell-off in technology and the Apple story. Look, the butterfly flapped its wings in America on Friday, and it was reverberated globally. Look at what the topics and the Nikkei have done. The velocity of the sell-off here, it cannot be understated. I've had a variety of people messaging on this. So it really is a brutal sell-off in topics and in the Nikkei. And the consequence across the currencies, you've had an unwind in the carry trade. We've just had Peter Kinsella there say he wouldn't be surprised to see a break of 140. We've short covering to this level. The next leg is actually buying yen.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself. I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Page news for you now this Monday morning. There are other headlines around the world. First up on the cover of the Journal, and the FT and others, it is the global red, the Nikkei, the Stock 600. Stocks around the world are plunging. The VIX futures climbing above 40 points, indicating Wall Street expects more market turbulence. Washington Post has another story on papers around the world about how Israel is bracing for retaliation after Iran calls the killing of Hamas's top political leader in Tehran a mistake. Let's take that story. Let's get to Jumana Basetchi. She's our host of Middle East and Africa Horizons. Jumana, the world is on tenterhooks to see what the reaction function is from Iran towards Israel. Of course, we've seen the color of that kind of response mechanism earlier this year. So where are we in terms of that? What narrative are we hearing from Iran on the potential for a response to Israel on the attacks that they made last week?
Well, it certainly feels like a retaliation is nigh. The U.S. Secretary of State Antony Blinken had a call with his counterparts, other G7 foreign ministers over the weekend. Axios reporting that he told them to expect a retaliatory attack on Israel by Iran and its proxies in the next 24 hours. And indeed, the U.S. Central Command officer is in the region. The U.S. is deploying extra military warships, fighter jets to the region as well in anticipation of this potential response. And equally, you hear of airlines canceling flights into and out of Tel Aviv and Beirut. The embassies in Lebanon advising their citizens to leave the country, including the likes of US, UK, Australia, and some of the Middle Eastern countries as well, Saudi Arabia and Turkey. This as the Iranian Foreign Ministry this morning put out a statement saying that Iran will take serious measures to create necessary deterrence. So the question here, Manas, is are they looking to create an escalatory stance or to create deterrence? And that is the one that will be answered in the next coming days.
Yeah, well, we just look back to April when there was those 300 projectiles sent into Israel. Most of them were brought down, and Biden calling for a hostage deal that needs to get done. Jumana, thank you very much. Markets are moving. Risk off in equities. Money flows into the bond market. You are looking at some of the biggest sell-offs that we've seen. Now, we're bouncing from the lows. We're down 6.5% on the NASDAQ at one juncture. Money is flowing into the bond market, as I say to you. And the risk of an intra-Fed cut coming, according to Peter Kinsella, Union Bancaire Privé. He sees it as being low. This is not 2008. Union Bancaire Privé.
you are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York, I'm Manus Crenny. Let's set your agenda. A global crisis of confidence in growth and the Fed stokes a dramatic repricing of rates. Traders now bet a 60% chance of an emergency Fed cut within a week. A tech implosion. NASDAQ futures rebound from a drop of 6.5% after entering a technical correction on Friday. This as Berkshire Hathaway bails on Apple. And the yen rally intensifies as carry trades unwind. JGBs fall the most since 1999 as the Topix enters a bear market. A very good morning to you. How do you feel this Monday morning? There has been definitely not just a growth scare, a consideration of the Psalm rule. Should the Fed be cutting rates? They're behind the curve. This is a growth scare, and this is a concern about central banks being behind the curve. The NASDAQ down 4%. It was down as much as 6.5% at one juncture this morning. The narrative is building that the Fed may need to do an inter-meeting cut. The probability of that stands at 60%. This time on Friday, I said to you it was a nano possibility. It's now morphing into a market narrative. March 2020 is your benchmark. 150 basis points of cuts in March 2020. We are not in March 2020. This is not COVID. This is not GFC. JP Morgan and Citi call for 50 basis points of cut. You've got the SPOOs down 2.4%. Berkshire Hathaway guts their position in Apple's cutting their position in Apple by 50%. So you are just seeing Apple under pressure. The whole of the tech sector is taking a real hit this morning. The supply chain into Apple as well. Nvidia is down 20% from its peak. Julian Emmanuel, soothsayer to the market. This is nothing but an air pocket. We've had plenty of them between 1995 and 2000. It was a tough 2000. But is it an air pocket or something more malevolent? Roll it over, have a look at the bond markets. You have seen a crushing of yields. In actual fact, yields, rates are acting much more of a haven basis than in the period of SVB. And this is critically important. By the way, the short end is moving lower again. That is an acceleration down in yields in the past 30 minutes. We're going for a hellish hard landing. That is what the bond market is telling you. Havens are bid, yen is up, dollar is down, Swiss is up, dollar is down. And this is leg one of that move, according to Union Bancaire Privée. There will be no intra-Fed cut from them, according to Union Bancaire Privée. Let's get to our reporter, Justina Lee. She joins me now. Obviously, Asia has had a brutal sell-off on the Topix and on the Nikkei and a strengthening in the yen. Just talk me through, Justina, good to see you this morning, the intensity of this sell-off and just how pervasive it has been.
Yeah, it's pretty incredible how we so quickly went from, bad news is good news to bad news is bad news. And I think it goes back to the job market kind of last week, where we kind of got a bit more indication that perhaps the U.S. is headed for a recession. But I think the intensity of this sell-off kind of speaks to how stretched the soft landing trades were, because people were pretty confident that was happening. So they were putting on carry trades, selling volatility, buying tech stocks regardless of valuations. And now we're kind of seeing a lot of that unwind. And a lot of the time you get that reflexivity in markets, and I think that's in full display today.
Justina, thank you very much for putting some context around that for us. Let's bring in Jay Woods, Chief Global Strategist for Freedom Capital Markets. How are you doing? This is a rough Monday morning to come into. We're all hoping for a little bit of short covering. How tenuous is this in your perspective?
Yeah, we didn't need these Japanese headwinds on top of what happened last week after the unemployment numbers. So this is one of those things where when you live through it, you got to put it into perspective, and that's what we're trying to do. We're in the midst of a correction, 10% down in the NASDAQ 100, going to be a little lower today. You get your shopping list out. You want to look at where the opportunities are, because this is August, September, historically, 2 worst months. We've been down the last 3, August and September's last 3 years. So this is kind of normal. These are seasonal headwinds accelerated with some big headlines, some geopolitical concerns. You mentioned before this, the tensions in Israel, and then an election season. So the headlines are going to really make us focus on this sell-off. But as someone looking at the fundamentals and the patterns, this is a buying opportunity, and one that when you go through it, you don't want to, you don't enjoy this. But when you put it into perspective, I think we're going to be okay.
Can I challenge you a little bit? Because I just don't feel that this is a kind of normal August at all. I have rarely lived through 43 basis points drop. I mean, my worst margin call in bonds was in 1994. I haven't seen twos drop by 60-odd basis points in this space of time. What's the bond market telling me that the equity market is barely catching up?
Well, the bond market is moving at a ridiculously rapid pace. So it's telling us, one, that the Fed messed up last week. They should have cut. That was the biggest problem. And then you get that unemployment data. Now, it was a little skewed. No one talks about Hurricane Beryl adding to that unemployment on the temporary side. But yes, we're still coming off historically low unemployment, 3.4% to 4.3%. You tell me 10 years ago we're at 4.3% unemployment. All right, life is good. Inflation is dropping down to 2%. So step back. Let's look at it. Yes. Somme rule. Is that where you're about to go?
I was just about to say, I was just about to say, where are you? Because the Somme rule has been a fairly prescient indicator of tougher times to come. I suppose the question is this. Yeah. If it's not GFs, so let's just lay out the framework. So 6.5% drop in the NASDAQ this morning. Bonds down by 60 basis points in the space of a week, the short end of the curve. So the context is this. This is not GFC. This is not a pandemic. This is potentially, now the markets are saying to me, something more than a soft landing. That's what these markets are telling me. So what does that do to risk in your view?
Well, I mean, I think you want to look for opportunities. So I think this is still a risk-on environment. I think this is a long-term secular bull market. And given these headlines, given what's going on, go back to perspective. That is the most important thing. Yes, the Somme rule was triggered, but that was created in 2019. Even Claudia Somme, the author, said that this time could be different. It is statistically proven to be the best indicator, but so were 2 negative quarters of GDP. We had that. Nothing happened. We had the yield curve has been inverted for the longest time. So I think this time may be different. Wake up to this morning, you don't feel it. When you look at the fundamentals, I worry about the story out of NVIDIA today.
I mean, down 20% from its peak. That's now technically in a bear market. You've gone through correction. It went like that.
Well, we had a 20% correction March, April in NVIDIA, and then we had a correction last August 24th. They had the best earnings ever.
So this is an air pocket. You're with Julie and Emmanuel. You're going for lunch, and the two of you are rubbing hands, and you're going to an air pocket. It's an air pocket.
It is, and look at this 95 level technically in NVIDIA, and you have what you consider an opportunity. People have been waiting for this. Oh, when can I get in? When can I get in? When it happens, that's when you get scared. So this is, through experience, you learn that over the long term, these are great opportunities. Will it be the low today? No. But this is an opportunity where you get your checklist out and you put in some low ball bids, and maybe you get lucky, and maybe you end up looking at your positions. You know who's happy today?
Go on.
Warren Buffett. He's very happy today. They have the most cash on the sidelines. You think he's just going to sit there and watch this and do nothing? No, he's getting ready to go shopping. And that Apple position, he had 50% of his stake in Berkshire was Apple. He had to cut it back. I didn't think it would be this dramatic, but it's something to watch.
It's interesting because we have had Nancy Tengler in the seat, and she said, not owning NVIDIA is a bit like having a root canal without Novocaine. And here we are. You look at some of these drops and you say to yourself, look, the world isn't stopping. We're not going to not buy iPhones. Yeah. We're not. Companies are not going to AI-itize. They're not going to not spend. And so therefore that's when the flow of money comes in. But then let's just take it to the small caps. Danny's not here. Homage to Danny. She'll be on surveillance in a while. And you can be pretty sure she's going to be talking about small caps there. But you've had this great run up in Russell through July. It was the best outperformance by small caps to big caps since 2001. I've got to reprice that now.
You do.
I know we've already begun to reprice it, but do I more dramatically reprice that?
Well, the Russell has been the most dramatic mover. When it rallies, it rallied 27% from October to December last year. It had a rally of almost 20%. It almost eclipsed the NASDAQ 100. Yeah. Last Wednesday, we were talking about it being the leader of the indices. So the Russell is super sensitive to these moves. It was a rotational move. We saw people get rid of their winners. They went into the losers. They looked for opportunity. They went to the Russell. Well, that rotation trade is now over, and the tide is taking out all the boats right now.
Is that the understatement of 2024?
Yeah, well, it lasted for a great 3 weeks. It was fantastic. But, yes, Danny is not going to be very happy this morning. I still think there will be a nice opportunity year-end for Russell. Once we start getting into this cutting mode, we are in a cutting cycle. That is known.
So what does it take to get the Fed? If we don't have as it were, a cut in between, what does it take to do 50 in September?
Well, I think 50 is on the table for September. And Jay Powell, I'd be shocked if they did do an intermediate cut. The last time they did that was COVID. I don't feel like this is a COVID emergency right now. It stinks, but no. So I think watch Jackson Hole, watch some of the Fed speakers over the next 2 weeks going into that. Jackson Hole 2 years ago, if you remember 2022, he threw cold water on a rally when he said he was raising rates. He can do the exact opposite this year and say, all right, we know we need to cut. We didn't expect unemployment to accelerate as much as it did, and they're going to take the necessary measures, watching each data point one at a time. He'll go back to his boring little narratives. He's never going to panic, and I don't think we're going to get a cut until September 18th, unfortunately. But when he does it, I think 50 basis points is on the table, and he will orchestrate that and tell us step by step how he's going to do it, because he doesn't break from script.
Do you think market participants are more inclined, to take risk rather than hide? In other words, deploy rather than run? Because I'm seeing haven in FX, in yen, in Swiss, and in rates. So I just wonder, can you wrap it up in a day and sort of say, look, today, Manus, this is the low point. It's a realization.
No, this will take time. This will take several weeks, and I think Jay Powell
of high volatility, several weeks of high vol.
Hey, high volatility. The traders at the exchanges, they're very happy today because they're going to get some extreme volatility. That is a good thing for someone looking at the portfolio. Just put it away. Watch something else.
Don't look at the valuation.
No, don't. But like I said, just be smart. Look, nothing fundamentally has changed. That NVIDIA story about the chip delay, okay, that has me worried. But when you look at earnings, we're still getting earnings growth. We're still expecting to get further earnings growth, especially in the small caps. So that's why I think the fourth quarter, we'll see them come back. But nothing has fundamentally changed from today to yesterday. Powell just missed an opportunity to cut last week, and the market is telling him you screwed up.
Well, he's being punished quite brutally. Jay, thank you so much. Context this Monday morning, Jay Woods of Freedom Capital. Across the equity markets, as Jay has just said, it perhaps is an opportunity for you to think about this. You're looking at as bouncing from our lows. We were down 6.5% at one juncture. The NASDAQ is now down 4.49%. Volatility, by the way, is at a 4-year high. So, this is going to be a bumpy ride. In terms of the differential of what comes from the Fed, JP Morgan and Citi are now talking about a 50 basis point cut. So equities are under pressure, and the Russell really taking a beating this morning, down 4%. So that just shows you some breadth on the market. So there's a 60% odds of the Fed cutting within a week. Is that real, or is that just panic reaction in the short end? Good morning from New York.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bloomberg Brief, I'm Manus Cranny in New York this Monday morning. Politics also top of the ticket. The Vice President Kamala Harris is nearing the finish. The presumptive Democratic nominee met with a short list of 3 potential candidates on Sunday and spoke with a few other contenders as well. According to people familiar with the matter, let's get to Kriti Gupta. She's been tracking the political story for us. So, look, Shapiro has been the hot name over the past number of days. Is the pack narrowing, and is he rising, or is it split odds at the moment? Kriti, good morning.
Good morning, Manus. It is kind of a split, and I would originally say a 3-way split, but there's still some other names that are kind of seeping into the narrative. Remember, on August 7th, by August 7th, Kamala Harris is expected to be the Democratic nominee by virtual roll call, but some of the names we're considering, you mentioned Josh Shapiro as the favorite, others as well. Mark Kelly over in Arizona, a major swing state. Then you have Tim Walz over in Minnesota. But then, Manus, you also have names like Andy Beshear, for example, who's the governor of Kentucky. He's been very vocal on the labor front and earning the endorsement, the backing of the UAW president, Sean Fain, as well. So this is a really big story about not just finding a white male centrist to kind of balance out the ticket from Kamala Harris, but also finding someone who appeals to the larger kind of labor movement that you're seeing take shape in the states.
And I suppose the question is, you know, there's been a lot of debate over the weekend about the parameters or the guardrails that might be set up over a on-stage debate between Harris and Trump. So where are we going with that? How important is that in the evolution of this campaign? Because both sides have been chiding one another, to say the very least.
Well, it's very important. And remember, this comes in the context of CNN actually being able to secure both Joe Biden and President Trump on one debate stage, but also ensuring that things like live mics or mic muting, for example, was going to have live fact checking was off the table. So these are things that now I believe ABC is going to be moderating or attempting to moderate the September 10th debate if President Trump does agree. But this is going to be something that takes place in the way that they really deliver or execute, I should say, the debate. And fact checking is a really big part of that. Having a potential live audience is another part of that. The CNN debate didn't have that either, and that is a real departure, Manis, from the norms from the political space when in the lead up to the election.
Critty, thank you very much. It's going to be a hot week for politics and markets. They are colliding at a vicious rate. Critty up to that in London. The bond market is ground zero for growth scare concerns. Equity markets have taken their lead from that. You've got stocks down 2.7%. The Nasdaq was down 6.5% at one juncture. Apple and Nvidia have also taken a brutal push lower this morning. Nvidia 20% lower from its peak. Julian Emanuel debates whether it's an air pocket or something more malevolent. This is the bond market. 10-year government bonds crashed 40 basis points last week. You're down a further 5 basis points this morning. You're looking at not just a narrative going from a soft landing, but almost, Peter Cheer over at Academy talks about holy recession, Batman. And that is, you know, the tail that's wagging the global dog is the U.S. market in terms of a growth scare and a central bank which is behind the curve. German yields down, as you can see there, another 5 basis points, and likewise in the U.K. So the narrative will build not just for faster and more aggressive rate cuts from the Federal Reserve. JP Morgan, along with Citi, talking about 50 basis points now, but traders pricing in a 60% odds of a Fed cut within a week. On Friday morning, we speculated that there was a tiny percentage possibility of a rate cut between now and September, and that's blown out to 60%. Money flows into the havens of yen, of Swiss, of bonds. The short end of the curve is getting crushed. Coming up, we'll set up the agenda for your earnings and the Fed speak. What will the jawboning be about rates? That is the definition of intervention from the Fed. Good morning from New York.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a 3.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
It's Bloomberg Brief from New York with me, Menace Craney. A check for the rest of the week. San Francisco Fed President Mary Daly speaks at 5 p.m. Eastern today. So let's see what the beginning of that pushback from the Fed looks like and sounds like. Earnings continue with Disney and Novo Nordisk reporting on Wednesday, and more Fed speak to come. Richmond Fed President Thomas Barkin speaking on Thursday. Traders are now pricing in a 60% chance of a Fed cut this week. Simon White joins us now. It's interesting, Simon, you know, we've gone from a slither of that being a risk to a 60% possibility. How real is that? Because this is not the GFC, this is not COVID, this is not March 2020 when the Fed cut by 150 basis points. Is this a small risk play or a real risk play?
It's certainly the distribution has changed, and in markets, that's what matters. So outcomes obviously ultimately matters, but right now the distribution has changed, and the market is reflecting that change of distribution. So the Fed, its main aim of obviously its official mandate is inflation and unemployment, but really what it comes down to is it's really trying to prevent these negative feedback loops developing between the real economy and between markets. And what's happening now, we're in that reflexive mode where all of a sudden things are moving considerably faster. So, the economy last week, today, they're very little different, right? Nothing has really changed there. Although you will get people saying, see, I told you so, recession was definitely going to happen. What's really changed is the market, through positioning, has begun to price in much higher chance of a recession, but that's precisely what makes it more likely. And that's why there's going to be extra pressure on the Fed to act. And that's not to say that's the right move in the longer term. That's throwing more fuel in the fire. But the reality of the situation is the Fed is in a sort of invidious position, right? Because if it does nothing, it will get a lot of opprobrium for, maybe not preventing a recession. And if it does do something, it'll get accused of pandering to the markets. But when it comes to this percentage that you're talking about, I think it's actually a little bit lower now. It's more like 20-25% of an early cut. But the problem is if you do get an early cut, by the way, it's unlikely just to be a 25. They're probably going to do something bigger. So again, your distribution has changed and your risk reward has really swung in favor of taking that outlook. Because if you're wrong, your downside is very limited, but if you're right, you have a very big upside.
It's very interesting, the reaction function. Yeah, I'm not saying there's not a bad reaction function in the U.S. equity markets, down 6.5% at one juncture on the NASDAQ futures, NVIDIA down 20% from its high. But when I look to the Asian markets, Topix in the Nikkei tumbling by more than 12%. The Topix had its biggest drop since data going back to 1959. Now, part of that is yen strength. That's undoubted. The speed of the move in yen, I think, is adding fuel to the sell-off in the equity fire in Asia. Is that a correct assessment?
Absolutely. I mean, look, the Bank of Japan keeping rates ultra low when everyone else was tightening has allowed these imbalances to build up. I mean, the Bank of Japan's got a very large balance sheet. Yep. And that's really been the powerhouse behind this carry trade. So look, people have been talking about this, obviously, for as long as it's been going on. Nobody can tell you exactly when the kind of last bit of sand causes the dune to kind of fall apart. But you kind of know the direction things are going. And Bank of Japan raising rates on Wednesday was really the kind of last straw, I think, in that game.
Simon, thank you so much for context this morning as we go into the surveillance 3 hours. They'll take you through the rest of the risk in this market. Volatility is spiking to the highest level that we've seen in 4 years. The consequence of that as the U.S. hits their desks is that we're heading towards some kind of a pretty tough landing. Bond markets rally.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. Mm-hmm. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
I'm hearing the market scream two things: growth scare, policy mistake. The Fed may be late.
The Fed needs to get going soon, just given that we have seen, I think, some market deterioration in the jobs market.
What we do know is that when momentum slows, it slows quite quickly.
Certainly there's a signal that September will be the first cut, but I think the Fed will still move very cautiously.
I don't understand the let's go really slowly. If the economy is back to normal, get monetary policy to normal quickly.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your trading week started. Wow. Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. And just like that, the narrative flips. We said it on Friday, if payrolls were the difference between the Fed having time and running out of it. At 8:30 Eastern time, Friday morning, there was a stampede to the other side of the boat, and that stampede continues. Your scores look like this. Equity futures on the S&P 500 negative by 2.5%. The Nasdaq down by 4. The winner of July, the loser so far in August, the Russell, the small caps down by 3.9. That's the price action at the index level. Take the single names. We'll pick out 3. Nvidia, Microsoft, Apple getting absolutely hammered. Nvidia down another 9%, Apple down 8%, Microsoft down by more than 4%. That's the stock market. The good news in the bond market is doing what it's meant to do. It's rallying. We had a 2-year The yield moved 50 basis points on the week last week. We're down another 9 at the front end, 379. On a 10-year, down 376. So how did we get here? We know how we got here. The data was weaker than expected. We had ISM manufacturing. Jobless claims on Thursday moving in the wrong direction. On Friday, payrolls definitely moving in the wrong direction. So we have to ask the question, how vulnerable are we to this whole story flipping in the other direction? So look at the week ahead. I want to circle two things. I want to circle the ISM services read a little bit later on this morning at 10 a.m. Eastern Time. And I'd like to circle jobless claims on Thursday. For all this talk of 50 basis point cuts, the Fed delivering an emergency rate cut, we'll put some real big question marks around those stories. And I have to say, Danny, we've got to ask ourselves at 10 a.m. Eastern Time, if we get a hot ISM service, a good one, a good read, how quickly does this story flip in the other direction?
Well, the concern is that the liquidity squeeze is so bad right now, it's hard to actually know where reality is. If people genuinely think we're going to get a Fed cut in 1 week, because that seems crazy just listening to the most recent Fed speak. The issue, though, is even though the move is unreasonable, it doesn't mean that it can't become reasonable. If you have this feedback loop where the equity market sells off, people price in an emergency cut, the Fed emergency cuts, everyone thinks that there's a recession, so they cause a recession. That's the fear I think is playing in people's minds, but that will have to do with how long this sell-off continues for.
We've got to frame how quickly all of this happened, how quickly things have moved, and also how quickly things maybe have overshot as well. Think about where we were at the start of July. July 2nd, Sintra Portugal Chairman Powell. This was the quote. Because the US economy is strong and the labor market is strong, we have the ability to take our time and get this right. That was July 2nd. The payrolls report dropped on August 2nd. Are we sitting here and saying things have changed that much in a single month?
But the thing is that this market was so built up around that. Again, this is what I struggle with. What is reality in this market and what is just panic and what is just selling? Because by all accounts, the Fed in the recent days has been very calm too. Not even just in July, but the presser. Powell was very calm despite journalists lobbing very dovish questions at him. You had Goolsbee talking to Mike McKee saying that it's just 1 month. It doesn't make a difference. You have so many people looking at the jobs report saying, something about it looks weird. Is this just the weather impact? So again, how much of this is just VAR shocks, people getting stopped out, and then you have these odd market moves?
Speaking of odd market moves, nothing calm about what's been developing over in Japan. And I have to say that this is a continuation of the story that started last week on the Nikkei 225. We closed lower by more than 12% overnight in Tokyo, Japan on the Nikkei 225, the biggest one-day move lower since 1987. In the FX market, dollar-yen, we've gone from talking about the 160s to the 150s to the 140s in just a couple of weeks. We trade right now in that currency pair at 142.39. We're negative on the session by 2.8%. Some vicious yen strength in this market. The broader story looks a little something like this. Equities doing badly, bonds doing better. A rally in treasuries pulling yields lower by another 3 or 4 basis points on a 10-year, 375.47. The dollar weaker across the board, the euro stronger, reclaiming a 109 handle, 109.41. That currency pair firmer by 0.25%. And just to underline the fact that we're talking about a growth shock here, we've got geopolitical risk on the table, and yet still crude is pulling lower. Danny Berger, 71.85 on WTI this morning.
It is remarkable because oil had somewhat held up last week. Sure, it was slightly weaker, but that geopolitical concern, to your point, made it go faster. And that's when you say, out of all of the things that can go wrong in this market, out of all of the things that we're worried about, it's clear that the growth scare is front and center. And that's an issue, again, because you get this feedback loop going, especially with the yen. If you get the yen appreciating, you get rates coming down, the rate differential between the US and Japan shrinks, and then that appreciates the yen even further. You got to ask, how does it stop?
It's taken on a life of its own, and it's feeding on itself. What's the circuit breaker for all of this? Coming up this hour, we'll catch up with Russ Kostrick of BlackRock as the stock market sell-off continues. Earl Davis of BMO on the potential for an emergency Fed rate cut. And Leila Richardson of ADP on why it's too soon to start talking about a hard landing. We begin with our top story. US growth concerns igniting a global equity market sell-off. Russ Kostrick of BlackRock writing the following. We've been trimming risk since June. For the time being, the market is likely to treat bad news as bad news. And Russ Kostrick, we got some bad news on Friday, so let's talk about it. I want to take a giant step back, just away from all the drama, the frenzy, the hysteria, and go back to July 2nd. Chairman Powell, Sintra Portugal. The economy is strong, the labor market is strong, we have the ability to take our time and get this right. Did things change that much Friday morning at 8:30 Eastern Time?
Well, good morning, Jonathan. I think this is the right question. My simple answer is no, I don't think they did. I think Danny was right a moment ago. This says as much, probably much more about market positioning as it does about how much the economic data has changed. So just two things to consider. First of all, it wasn't that bad of a labor market report. It was only about a year ago that we thought the natural pace of job growth for this economy was maybe about 100,000 a month. And we've really learned over the last year it's higher than that because of the increase in labor supply from immigration. But the reality is we're still printing, call it, an average of 140, 150,000 a month. That is above what we thought was a trend pace just a year ago. So not an awful number, a soft number, not awful. The other point in the bond market, and more particularly the short end of the curve, think about how much market expectations have swung around the last 7 months. We started the year with the market convinced the Fed was going to cut 7 times. You go back a couple of months, the market was convinced the Fed wasn't going to cut at all. And now we've got a narrative built up where they're going to do an emergency cut or go 50 bips in September. So I do think a lot of these gyrations are more about the market and positioning than the change in the economic data.
So, Russ, let's build on that just a little bit more. I went through the week ahead. I circled 2 things. Jobless claims on Thursday, ISM services a little bit later this morning. Let's just say at 10 a.m. this morning, we get a decent ISM services print, Russ. Do you think that's sufficient? Is that enough to flip this story the other way all over again?
Probably not one number, but I think it would definitely be a step in the right direction. I think you're exactly right also to focus on the services number. Now, again, as you pointed out a few moments ago, this all began Thursday morning with a weak ISM number, and it was weak. But the reality is that was the manufacturing read. We've already in the last few years had a pullback in the housing market. We know that consumer softening, but this is, as you know, a service-led economy. So if we get a confirmation that the service sector is holding up okay, it doesn't mean that the economy is not moderating. It is, but it does start to undercut this narrative that's taking hold literally within 72 hours that suddenly we've gone from a soft landing to an imminent recession.
Well, given that quick flip, Russ, what distinguishes the difference between a sell-off that you want to step out in front of and one you want to let run?
Well, I think there are a couple of things. The first of which is we do have to look at the data. Is the data confirming the market narrative? I think, as you've both suggested right now, that the market move looks very, very extreme. Positioning was extended. You've got to let that clear out. But you've already seen pretty significant correction, and there are going to be parts of the market where there's long-term growth that start to look attractive. You've seen the NASDAQ already correct over 10%. Semis and many of the AI themes have corrected 20, 25%. Again, I wouldn't wade in this morning with both hands, given how much we're going to see volatility until the market gets something to confirm that it's not as bad as it thinks. But some of the excesses, actually a lot of the excess that we were all talking about a month ago, that's starting to get corrected.
If you think about the last time you had a market sell-off to this magnitude, you have to bring up March 2020, Russ. And in that period, it was tech that acted as a ballast in the equity market. That's not happening this time around. You can argue that a lot of the sell-off has started with tech and some of the disappointing earnings. So is it different this time? Has the damage already been done in this sector when you see hundreds of billions of dollars in single stocks swinging around day by day?
Well, I think it's reminded people that, look, a lot of these names, they ran a tremendous amount. The AI names, the semi names on the AI theme, which got very, very crowded. But, the tech thing is interesting. So tech is sold off on the notion that, first it began in mid-July. It was a funding source for the small cap. And the narrative then was the economy is great. We've got a Goldilocks soft landing. Rates are going down. Let's buy the parts of the market, i.e. small cap, that are most sensitive to rates going down. But the reality is tech is also rate sensitive. And in addition, if we do start to think that, if nothing else, the economy is going to be softer, some of the trades that people were running into in July, the small caps, the banks, some of the lower quality trades, that doesn't make sense in an economy that's moderating. If anything, you're probably going to be more inclined to look for a higher quality, revenue consistency, earnings consistency. Where do you find that? You find that in a lot of the mega cap tech names, in some of the healthcare names. So I do think you're going to get to a point, unless you do believe there's a recession, where some of these names start to make sense again.
So, Russ, I understand you can't do single names, so I'll just do a couple. Myself, JP Morgan at the pre-market's down about 3, Bank of America's down, Citi's down, regional banks had a tough time of it on Friday. That's the banking story. Tech's getting hammered too. Out of these two industry groups at the moment, Russ, you saying look to pick up the pieces in tech and avoid what's taking place in financials, don't step in right now?
Well, I'd qualify that a little bit. I do think some of the large money center banks, are interesting. I think some of the smaller regional banks, that I think the regional bank index at one point was up 22%. Again, that's a strange play to make if we think the economy is starting to soften. So I wouldn't necessarily be bottom fishing there. But yes, I do think some of the mega cap tech names, some of the high quality healthcare names, some of the pharma names that have really been beaten up, these are going to offer some good long-term value because, again, all the trends we were talking about 2-3 months ago as trends that are going to go on for 3, 4, 5 years, they're still in place. We're still seeing tremendous CapEx spending. I don't think that necessarily changes, and these stocks are a lot cheaper than they were a few months ago.
Russ, just before you go, I just want a base case from you. Base case expectation now for the Federal Reserve. It feels like a very long road to September 18th, which is when the Federal Reserve next meets. That's the next scheduled meeting. Russ, what's the base case for you now, you and the team?
Look, I still think, we were talking about 2 to 3 cuts. I think I would still keep that as our base case. Obviously, if the data softens significantly in the next 6 weeks, they have the latitude to cut more given how high real rates are. But I wouldn't rush to assume that until we see some further deterioration in the data.
Russ, it's good to hear from you, sir. Russ Kostrick there of BlackRock, following some wild moves in this market from equities to bonds to foreign exchange and worldwide into Japan. Nikkei 225 getting absolutely hammered. There's been some big calls in the last couple of days. Immediately after that jobs print, Danny, we saw Andrew Honhorst of Citi go to a 50 basis point cut call for September. Saw Mike Ferroli of JP Morgan do the same thing. We'll catch up with Andrew a little bit later this morning.
You also had Goldman Sachs raising the recession probability from 15 to 25, but let's be honest, 25% is still not very high. And I think that's where we have to really coalesce around some of these calls. Sure, they're calling for 50, 50, 25 in terms of cuts. But again, that's not something like an emergency cut. That's not something like the sky is falling. And I got to be honest, John, a lot of these moves this morning are just that. They're the sky is falling type of trades.
That's what it feels like. We're down by 2.7% on equity futures on the S&P 500, just off session lows. Let's take the opportunity to get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hakez. Hey, Yahara.
Hi, John. We start with oil trading lower, extending its losses to a new 7-month low. Brent futures are now trading below $76 a barrel, erasing this year's gains, while West Texas Intermediate is now below $72. This comes as the market braces for a possible attack from Iran and regional militias against Israel in retaliation for the assassinations of Hezbollah and Hamas officials last week. Cryptocurrencies are plunging this morning. Bitcoin briefly traded below 50,000 earlier. The sell-off adding to a more than 13% drop last week. That was the biggest plunge since the FTX exchange imploded. U.S. exchange-traded funds for Bitcoin suffered their largest outflows in about 3 months on Friday of last week. And there's a debate about the next presidential debate. Donald Trump said in a social media post that the previously scheduled debate to be hosted by ABC News was terminated once President Joe Biden dropped out of the race. Trump presented a counterproposal to Vice President Kamala Harris to face off on Fox News 6 days earlier. Harris says she plans to be at the ABC debate on September 10th. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara again in about 30 minutes' time. Up next on the program, the Japanese yen sinking Japanese stocks.
If the Fed's cutting, I don't think we can be above 140 next year. If they're cutting a long way because there's a serious slowdown, then yeah, we can go back to 120 and see where we go from there.
We're at 140 already, 142 this morning. Dollar yen gapping lower by 3%. A conversation up next, live from New York this morning. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Live from New York City, welcome to the program. Let's get you some price action. Equity futures look like this. We're negative by 2.8% on the S&P 500, down more than 4% on the NASDAQ. The sell-off continues on the Russell. Last week for the Russell, worst week for the small caps going back to spring 23. Spring 23, you all remember March 23. We were talking about bank failures in America. It's that kind of shock, growth shock, taking place this time around. I want to talk about equities just briefly. Stuart Kaiser of Citi, reduce exposure. Our established view has been to run long U.S. equity risk until the U.S. labor market shows confirmed weakness. That is now under question. And that is the question. We get jobless claims later this week. So next stop for this conversation, ISM services later this morning, 10 a.m. Eastern time, the one to watch. Switch up the board and turn the page and get to the bond market. And let's talk about this monster rally we've seen at the front end of the yield curve. The 2-year making a move of 50 basis points plus, Danny Berger, just last week. After a 50 basis point move, I think, in the month of July, we're down another 12 this morning to 375.
This pendulum swing in the market has been constant and painful. Russ Kosterek talked about it there, this idea that you entered the year thinking that we'd get 6 cuts. That was the extreme that you wanted to fade. And then we went to no cuts. That was an extreme you wanted to fade. Now we're in the land of talking about 50 basis points cuts, an inter-Fed meeting cut 2, 60% odds of that happening. So is this yet another extreme you just want to fade, John?
Some of these consensus trades over the last few months have unwound in such a vicious way. And I think the perfect example of that is dollar yen. It's a break of 142, briefly. 141.99, we're down by 3 percentage points, and we're seeing some vicious yen strength. A move of more than 3 percentage points on the session. That's the story in the FX market. Under surveillance this morning, the Japanese yen sinking Japanese stocks.
If the Fed's cutting, I don't think we can be above 140 next year. If they're cutting a long way because there's a serious slowdown, then yeah, we can go back to 120 and see where we go from there. This is very much a function of where U.S. interest rates are. This was possibly the biggest carry trade that we've ever seen because the Japanese kept still while the Fed hiked and hiked and hiked and hiked.
So here's the latest. The yen extending its rebound against the dollar as concerns mount. The Fed is behind the curve on supporting a slowing U.S. economy. The move unwinding global carry trades and jolting markets around the world. Jeremy Stretch of CIBC joins us now for more. Jeremy, it's rare to sit here and look at a Nikkei 225 that's down by 12.4% at the close, but that's what's in front of me right now. It's rare to see the moves we've seen in dollar yen down from 160 to 140 in a very small amount of time. Jeremy, talk to me about the path of least resistance now, what positioning looks like now we've reset so aggressively, and what the limits are to some of these trades.
Good morning. Well, you're absolutely right. It is an unprecedented state of affairs in the context of the move in those Japanese stocks, but we have seen an aggressive reduction in position pairing even before this week. So we'd already seen yen shorts effectively halved over the course of the last couple of weeks, but I think those have probably been cleared out now. So I think we've got a much cleaner market perspective in this particular juncture. But obviously, as your previous contributor suggested, if there were to be a very aggressive path of monetary easing from the Fed. Now, I think, I was listening to Danny just before we went to the break, where she was talking about the markets being priced for the sky falling in. Well, I don't think the sky is falling in. Yes, we see a slowdown in the US. Yes, we see a recalibration in terms of macro dynamics, but I don't think necessarily we should be getting carried away with that Fed pendulum effect and suggesting that we should be looking at intra-meeting or 50 basis point moves. So I think we've cleansed markets, and I think once we get back to a sort of a 140, the 140 handle, I think is probably a sort of an extreme or a support point at this particular juncture as we reassess the macro environment. And I think for today, services ISM is going to be particularly instructive, as well as obviously Mr. Goolsbee from the Fed.
Jeremy, if I can just push you on the positioning point for just a moment, and then we can move on to some of that. You say that some of the shorts have been washed out. But is there more that is structurally riding on short yen than we maybe failed to appreciate? Things like using the yen as a funding for going long tech, things like people who are just more structurally short yen?
That's true. I mean, and obviously when we do get to market dislocations and when we do see substantive pockets of weakness in various sectors, then clearly we often have to see a position cleansing in terms of sort of recalibrating those positions and and dealing with particular losses in certain sectors. So clearly it has been the case that part of the funding perhaps for the record surge in tech stocks has been funded out of cheap yen. So in a sense, there is an obvious dynamic in that regard. I think there is, as I say, a story of a slowdown effect, which obviously was the Fed's intention. But I think the market, as is often the case, is overblowing this situation in the near term. Yes, we're seeing a slowdown, undoubtedly. Are we seeing a recession in the US? I don't think we're necessarily there yet. And I think, in terms of those recession probabilities, we should, remember that 25% recession probability is 75% no recession probability. And I think that's the way that we would probably still view the market. But clearly there is still some yen dynamics which are playing out, and that will continue to oscillate in what are relatively illiquid and thin summer markets.
Sometimes, unfortunately, it's good to get a reminder of how percentages work, Jeremy. I think the market needs that this morning. So what stops it? What stops this sentiment down spiral that we're seeing? Is it running out, or, as you mentioned, data coming in stronger this morning?
Well, I think the data, is going to be particularly instructive this morning because, of course, if we go back to the back end of last week, the start of the sell-off was obviously precipitated by the weakness on the manufacturing ISM. And I think the manufacturing data in the US is important. Of course it is, but I think we shouldn't lose sight of the fact of the huge influence of the services sector. Now, we have obviously seen some weaknesses in services over the course of the last couple of months. Now, the market is anticipating a move back into an expansion dynamic in services ISM. Now, will that be enough to arrest the downtrend? Perhaps not, but I think it will at least put an element of doubt in terms of this magnitude of recession risk, which has been amplified by that non-farms reading on Friday, particularly the uptick in the unemployment rate and the discussion regarding the SARM rule, which obviously was mentioned in the Fed press briefing last week. And I suspect Mr. Powell would rather have an opportunity to recorrect some of his responses. But inevitably, I think we're now going to be watching and waiting for not only the data, but the 2.5 weeks until we get to Jackson Hole.
We'll catch up with Claudia Sam a little bit later on this morning. Jeremy, I just want to get to this quote from Neil Dutta. I'd love your thoughts on it. I'm going to share it with our audience. The Fed stepped on a nail. Thankfully, they've not stepped on a bed of nails. What we are dealing with now is the result of monetary policy being too tight. This means the solution is quite simple. Neil Dutta implies this is going to be easy to deal with, Jeremy. The Fed's at 550. It's got a big cushion it can use if it needs to. How easy is it to address this situation?
Well, I think that's true. And as with monetary policy, what we've seen from central banks is during the period that they've been building in a cushion in terms of a safety net to allow them to ease policy in a conventional fashion, not being forced into unconventional policy adjustments. I think the problem from the market's perspective is that we've just had a Fed meeting, and it does seem like an awfully long way away until that September FOMC meeting. As I say, that's why I think Jackson Hole cannot come soon enough for the markets, because they would like to see some recognition from the Fed that policy easing is coming. But clearly there is plenty of latitude and scope for conventional policy easing. But in the context of the Fed pendulum, we are very much in a scenario that at this particular point, markets are getting very exercised not only about the scale of monetary easing in 2024, but the risks or the potential optionality of thinking that the Fed will be forced to move before the next scheduled meeting. But the Fed has a latitude, but I think we need to see some commentary from the Fed over the course of the next few sessions.
That Fed get-together in Jackson Hole, Wyoming, just a few weeks ago. Jeremy, thanks for jumping on the phone. Appreciate it. Jeremy Stretch there on that breaking news out of Japan. Dollar yen with a move of 3% in the yen's favour and a move of 12.4% lower on the Nikkei 225, the biggest one-day loss going back to 1987.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
So many notes dropping this morning from the south side. Plenty of thoughts. I'll share some of those thoughts with you. Mislav Matejka over at JP Morgan. Here's the take from the team over in London. The investor outlook is still overly complacent. Concentration risk remains high. The VIX has not had a proper capitulation for quite a while, and credit spreads are extremely tight. We continue to believe that international equities will be weakening during the summer. That's what's happening right now. We're down another 2.9% on the S&P 500. NASDAQ futures down by more than 4%. And the loss is picking up, I tell you what, the small caps. The Russell's down by more than 5 full percentage points. Danny Berger alongside me to work through this morning. Danny, the losses last week on the Russell, we were down almost 7% on the week. Terrible week of losses, the worst going back to spring of 23. The Russell was up 10% in July. You know, what's happened? How has the pendulum gone from here to here in just a week?
And there are so many people who, after the Fed started to talk about cuts, were really excited after that Wednesday decision and just jumped on. There was a big rally in the Russell 2000 on Wednesday after that Fed meeting decision. So many people went long the Russell in recent times and just got smacked in the face. But John, I mean, the move, looking at a VIX that's at 50 right now, after it was stuck below 20 for so long, there are so many people who are getting hurt in today's trade, and a lot of it, you just got to wonder how many people are just looking at their winners for the year and selling them because they can't face more losses.
I'm not sure who's left in the bond market that's still short treasuries, because this would have been really painful the last week or so. The 10-year, the yield has been down for 7 consecutive sessions, and you can make it day 8. The 10-year yield's down 5 basis points, but the bigger moves have been at the front end of the curve. We saw this develop in July, down 50 basis points in July. And then it just happened so that last week delivered another 50 basis point move. 50 basis points on a 2-year yield in a single week. That was the move lower last week, and we're down another 12 this morning, down to 375.41 on a 2-year.
At least you can say bonds are doing what they're supposed to be doing, that we have somewhere in this market we can go to for safety. But that's creating this environment where we're pricing in a Fed cut in the next week, which again is kind of crazy considering the calm we've heard from the Fed and the fact that the data isn't that bad. If you look back to other crises in the market, you think about the quant quake, LTCM, when the Fed did step in, the difference that time was the sell-off was about the Treasury market. This time it's about equity. So I don't think we can be as certain that the Fed is going to step in this time around.
These were shocks to the system. Think about the last big shock to the system in the last 18 months. You go back to spring of 2023. We had bank failures. What did the Fed do? The Fed carried on hiking interest rates. That's what the Fed did. Now, maybe you can sit here and say that inflation is so much lower now. They've got a cushion. They should want to insulate the labor market. I want to go back to the Goldman call, and we'll spend some time on the Goldman call a little bit later. Yes, Goldman have lifted recession odds, but ultimately, they think it's going to take another jobs number like the one we got on Friday before you really start having a real conversation about 50 basis point moves in September.
I think the only argument you can have today is just that the wealth effect is so bad that they have to cut, that people believe that a recession is coming. They act like a recession is coming, so the Fed has to step in. And we can also debate whether a Fed stepping in would make things worse or better. If they come in with an emergency cut, all of a sudden people freak out more because they decide that the Fed is also in panic mode. I'm not sure that's a good thing for this market, but also you need just more than one day of a big sell-off to really say there's a wealth effect happening.
Well, we've had some big moves in dollar yen, so let's talk about this move in dollar yen. Last Monday, dollar yen opened up at 153.82. And here we are right now at 142.08, down by 3%. And if you thought that move was big, just check out Japanese equities overnight. Danny, we've got to keep going back to this. A move of 12.4% on the Nikkei 225, the biggest one-day loss going back to 1987. How many people have come on Bloomberg, come on this program in the last few months and said, I like Japanese stocks, and we've said to them, what happens if dollar yen goes from 160 to 150 to 140 to 130 to 120? And they've said this is not about the currency.
Yeah, they've come on and said that there's corporate reform happening in Japan. Companies are stronger. There are wages picking up, and all of that is a good thing for Japanese companies. But they overlook the fact that Japan's been used for a funding currency for so many different trades, that there is a systematic issue if the Japanese yen does start to appreciate. It's not just about the fundamentals. The fundamentals, by the way, which were based on, I don't know, a lot of tourists coming to Japan, it's not exactly the strongest legs to stand on.
A lot of trades built on top of that foreign exchange market and that currency pair. Under surveillance this morning, the global market sell-off accelerates as concerns over a U.S. economic slowdown intensify. Mega-cap tech names bearing the brunt of all of this, NVIDIA and Apple, both seeing some very sharp drops this morning. If you check out shares of NVIDIA, we're down by almost 10%. This note came out from Bank of America over the weekend, and they say this: we see any sell-off in this name as an enhanced buying opportunity. We don't get the earnings until month end.
It's scary to step out in front of these right now because of just how long people have been and the fact that they are still up this year. Maybe not Microsoft, that's erased its gains for the year. But from 2022, this is an S&P that's still up some 20%. It's NVIDIA that's still up 833% from 2022. There are gonna be people who are still long this thing and are still sitting on gains. That's not something that means that the sell-off at this moment can stop. I mean, there's still plenty of people who could sell.
That sell-off continues this morning. Need to get you an update on the politics as well. Kamala Harris expected to announce her running mate in the coming days. People familiar with the matter saying Harris held weekend meetings with Arizona Senator Mark Kelly, Pennsylvania Governor Josh Shapiro, Minnesota Governor Tim Walz as well. Meanwhile, Harris and Donald Trump differing over a potential presidential debate, Harris preferring a September 10th debate on ABC, while Trump calls for a debate hosted by Fox News a little bit earlier. I think for the politics, you have to go back to Friday. This could well change the election. If that unemployment story is real and not a head fake, and it continues going into November, then the Democrats have got a bit of a problem.
Yes, you can use a corollary for this on the other side of things. When Obama was seeking re-election and they said, okay, the unemployment rate is really high, it's something like 8%, this is bad for Obama, but the trend was down. We have the opposite thing right now, where you could say the unemployment rate, it's not that bad on its surface. It is just 4.3%, but the issue is the trend is up. It's trending in the wrong way, and that's going to be an issue for this party.
We've been heading in the wrong direction for a number of months now as well in that labor market. Check out the bond market. Treasury's surging. On growing bets, the U.S. economy is slowing so quickly that the Fed could cut rates within a week. Al Davis of BMO is writing this: the weak employment data shows job growth slowing, but the economy remains solid. The Fed didn't cut rates in July, but a 50 basis point cut in September is possible due to the stimulative fiscal deficit. Al joins us now for more. Al, let's get into this. Let's take a giant step back. I did that with Russ Kostrick earlier this morning. I think we have to do that repeatedly throughout the whole of this morning. What happened on Friday, Earl, and did it change things enough for you to make some big calls, like some of the moves we're seeing in this market currently?
Yeah, what changed in Friday is that the Fed has been alluding that now it's all about employment, not inflation. So when we got the number that we got on Friday, people ran to the doors, and the door is only so wide. So that's why you get this acceleration of the move. Has it changed things for us? Different time frames, yes. So let me tell you about the short-term time frame. Friday was a very good day for us as active fixed income managers. We were long overweight duration heading into Friday, but not only did we cover that overweight, we started shorting the market now. So Friday, close to the lows, we put on, let's call it 1/3 of our max short. Today, at 370 or better into the 10 years, we're going to put on another third. And then we're waiting for that extension of the sell-off due to stop-loss selling, and we'll put on our last third. We anticipate that'll be this week. We have a high amount of confidence in shorting the markets at these levels for two reasons. One, obviously, treasury supply. But I was a bond trader for 12 years, and what happens in this type of market is you get a lot of corporations looking to extend their issuance of credit of corporate bonds to 10 years because they take advantage of this rally with lower funding costs Your credit spreads are still historically tight. It is an excellent opportunity for them to get involved in the market. So what happens is they agree with dealers that they want to lock in these treasury yields, and dealers now start selling treasuries to lock in these low rates. That's how they lock in low financing costs before the bond issuance. Tremendous opportunity here to shorten the market, but it could extend.
I'll just build on that a little bit more, because we've seen a ton of supply from corporate credit through the year so far already. What kind of numbers are you and the team thinking about? How much front loading for the rest of the year are we about to see?
Well, it's a great question. We haven't thought of the exact number, but we do know, and this has been some pushback that we've gotten from clients, and then after our response, they're good with it. We do expect it to be more than the existing demand for buying, which means your credit spreads will widen. However, this is an important thing to remember. When you have these risk-off moments, what you have are people who historically invest in equities start looking to diversify that risk, and they like corporate credit as well. So they mix both of those two things. So we believe there will be additional demand that comes in with new corporate issuance. There's still trillions of dollars on the sideline as well, too, and the economy is doing well. Again, tremendous opportunity here from an active manager's perspective to be selective on the corporates and the credits that you go long. But this is what we've been waiting for. We've had valuation discipline for the past 3 months, but it's at these moments where we're adding to credit. We added to credit as well on Friday, and we will continue to do so over the coming weeks.
Earl, does that mean the slight spread widening we've had, and I say slight, especially compared to other risk market moves, something like 8 and 30 basis points for IG and HY respectively, that's kind of it, that it won't get much worse from here?
It will get much worse, but it is still opportunity. It's positive carry, and you're doing well. The reason why it will get much worse is because a way to think of being long corporate bonds and long carry, you're actually short vol. So in this market, when vol increases because of what's happening in the yen, carry trades being put out, the equity indices are being rocked a little bit. What happens is vol increases, your credit spread increases. So we do anticipate it to be more, but we do see, because we don't anticipate a recession either this year or next year, that will snap back in once the markets calm down. It's not immediate, and when it doesn't snap back in, you're still earning a positive coupon, positive carry. That's why we're legging into it, so to speak. We're not going all in on credit, but we are starting to add, and we will continue to do so.
What distinguishes the difference between spreads widen, equities sell off, and the corporates having an impact, the corporates acting different and having to respond to that, besides ones that can just sit still through the damage?
But it's a great question. So there's two sides to the coin of corporate bonds. There's me, an investor, so I buy it, I invest. And then there's corporations who actually need to fund the company. So when you get these tremendous rallies that you've been talking about, not only in your 2-year, but your 10-year and your 30-year, this is the type of market where corporates like to fix in their financing costs for the next 5, 10, 30 years. And the reason why is they've seen how high yields have been, last year, the highs of last year, even like July 1st, I think 10-year bonds in the US were testing 450. Now we're testing 370. 80 basis points of lower carrying costs or lower financing costs for 10 years is significant for a corporation. So that's why they look at this side of the equation. And you know what? There will be a lot of dealers that are knocking the doors to highlight the benefits of this, and that's why they get involved.
Oh, just before you go, we're just trying to gauge from investors, people in the market like yourself, how vulnerable this market is to flipping the other way all over again off the back of a firm print on ISM services a little bit later this morning. How are you and the team framing that data point later on today?
Yeah, I don't think it's vulnerable to flipping back, but this is, I'm happy you asked that question. The level in 10 years that we see at the pivot point is 385. So any yield below 385, we are better sellers, with underweight duration. Above 385, we start going long duration. It is our full expectation that we'll test both ends of that. We'll go above 385, but the trend now is definitely lower, but we could see us going much higher as well before we ultimately hit new lows. And that underscores one thing. Our number one highest conviction trade for 2024 coming into the year was volatility. That means, and we're seeing it, and that means the path is more important than the destination. So having ideas as to where pivot points are, where you're underweight, overweight, is the key to making alpha. And that's why we're very bullish on alpha in fixed income and active management.
Oh, this was super smart. It's good to get your thoughts, sir, as always. Good luck this week. Earl Davis there of BMO, Global Asset Management, after some big moves. He was long volatility. That's exactly what he's got on these screens right now. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. The Prime Minister of Bangladesh, Sheikh Hasina, has resigned and fled the country as anti-government protesters converged on her official residence. This according to local reports. She had faced pressure to resign for weeks following violent demonstrations that have killed more than 100 protesters. The nation is shutting down government and private offices, including banks, for 3 days starting today, and mobile internet service has been shut off. The country will now form an interim government with the backing of the military. Meanwhile, Israel is bracing for possible attacks from Iran and regional militias. This after the high-profile assassinations of Hamas and Hezbollah leaders last week. Prime Minister Benjamin Netanyahu saying over the weekend his country is in a, quote, multi-front war against Iran's axis of evil. Amid the escalating tensions, the U.S. is moving a fighter jet squadron to the region and plans to keep an aircraft carrier nearby to help Israel. Still, the White House is urging Netanyahu to redouble ceasefire negotiations with Hamas. And we're seeing shares of Apple tumbling down nearly 9% in the pre-market as part of this global tech sell-off. But we also learned over the weekend that Warren Buffett's Berkshire Hathaway slashed its stake in the iPhone maker by almost 50%. This part of a second quarter selling spree that saw Warren Buffett's cash pile soar to a record nearly $277 billion. Still, analysts are urging Apple investors to remain calm despite a delay in the company's much-hyped AI rollout. That's your Bloomberg Brief. John?
Yahara, thank you. I guess the real question, Danny, is how much you'd like to buy this morning off the back of this move.
I was thinking, what great timing from Warren Buffett. I mean, I'm sure he didn't think this was going to happen, but good timing for him and maybe bad for everyone who bought what he was selling.
Amazing. Yahara is going to join us again in about 30 minutes' time. Up next on the program, the long odds for a soft landing.
I'm hearing the market scream two things: growth scare, policy mistake. That is what I'm hearing.
It was screaming those two things loudly after that jobs report dropped on Friday. More still ahead. You're watching Bloomberg TV.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
If you are just waking up, good morning. Welcome to the program. The scores look like this in the equity market. Equity futures negative by 3 percentage points. There's a rally in the bond market. 10-year yields down by 5. 2-year yields down by 13. The dollar is weaker. The euro is stronger. The yen is much stronger. Euro dollar right now 109.40. Dollar yen 142.42. Under surveillance this morning, the long odds for a soft landing.
I'm hearing the market scream two things: growth scare, policy mistake. That is what I'm hearing. The market now fully understands that the Fed may be late in starting its cutting cycle. In the past, I kept on saying there's no reason for the US to fall into recession. I think people underestimated the lagged effects of higher interest rates, and these are hitting in a much bigger way now.
In a much bigger way. Here's the latest. Concerns of a US economic slowdown spreading worldwide after the July jobs report reinforced worries the Fed held rates too high for too long. Neela Richardson of ADP writes this: it's too soon to talk about a hard landing again. It is a bumping out but safe landing for the US economy, where inflation continues to abate and hiring increases modestly. It may be the case that in July data, the jobs market is reminding us of what normal looks like. Neela joins us now for more. Neela, it's good to see you. Do you think we are confusing normalization with something more nefarious?
Yes, and to answer that question, I'd like to take you back to July of 2019. The U.S. economy grew employment by 1.3% and created 90,000 jobs. Now let's fast forward to the present. 114,000 jobs, employment growing at 1.6%. This is normal. And the risk of over-exaggerating where we are, which is definitely a cooler labor market, but the risk of going too far in our sentiment is that we will have higher expectations for a Fed rate cut than we're going to get. The Fed will not deliver us from 4.3% back to 3.5% unemployment rate. And if we think that going into that September cut, we're bound to be disappointed in the markets, and that's the concern.
Let's talk about a place where you have some confidence. Do you have some confidence we can stabilize at these kind of levels in this labor market, that we can deliver jobs gains that look like that for quite a while, and we don't just sort of head on this one-way track towards negative numbers at some point in our future?
So I'm going to give you an insider's perspective of the labor market. I'm going to give you that perspective because I see about 25 million paychecks every single month, every single week, and we've been looking at the labor market in this really fine-tuned, granular way. And what I will tell you is within all of this, hiring is different now than it was in 2022 and 2023. We are not just replacing workers in this labor market. Remember that revolving door of the Great Resignation. Remember how hard it was to lure workers back into this space. Remember how quickly they left once they got there. Employers are not in that position anymore. They are hiring because and only when they are growing by and large. Yes, of course, some people leave the labor market. There's maternity leave, there's early retirements. But on net, it's real headcount growth, not just replacement hiring. It's a very different space than employers were 2 years ago.
Does that also mean that the labor hoarding that we've seen from companies, keeping on and holding on to employees for fear that they couldn't replace them, that's over?
I think it's too soon to say that.
Okay.
What we have seen in the data is that employees are not leaving as quickly as they used to, that they're staying put, that the turnover rate isn't there. You can see that in the JOLTS report. You can see it in the quits rate. Quits now are back to where they were pre-pandemic, even a little bit lower than they were pre-pandemic. So in that reality, when companies may have overhired, thinking that some of their workers would have left, they are tweaking their headcount at the margins to correct for what may have been a bit of a rambunctious hiring a few months ago.
I wonder, though, when you look at a market doing as it is today, when you look at sentiment turning, is there a fear that corporates are going to be more reactive this time around, that they do have, for a large part, a large labor force because of some of the overhiring that they've done? So when they finally let people go, it's sort of like the beach ball that's been kept underwater and you finally release it, and a lot of people are let go.
Well, to answer that question, let's go back to the data. Let's go to the labor force productivity numbers that were kind of lost in all of that labor data last week. You know, there are more workers and workers are becoming more productive. So in terms of a corporate earnings perspective, having a more productive workforce is actually helpful. it's helpful to earnings. So I'm still in the camp that these are minor tweaks if you do see a reduction here or there. When we've seen large-scale layoffs, they have typically been in specific investments that companies have made and maybe they've pulled back from. But by and large, in order to keep growing, in order to meet those earnings expectations, you have to keep your workforce and you have to make sure they're productive. And that's what we're seeing in the macro data.
As you know, there will be a big get-together in Jackson Hole, Wyoming in a few weeks' time. What do you think the tone of that get-together is going to look like now? Because we've said already this morning, the road to September 18th for the next Fed meeting feels like a long, long way away.
I think they're going to be able, these policymakers, to come together and take a breath. They've been so tactical, data dependent. Okay, not data point dependent, but very data dependent. Now they can talk strategy, and this sets them up for a conversation that they are going to need to have going into next year about the framework. Remember that the current framework that we've been operating under anticipates a very different inflation scenario than we're in now. That framework where we can let inflation be a bit above the 2% target up to 2.5% on average anticipates a very low inflation rate as normal. We're not in that world anymore. So they have to start going from this data dependence tactical maneuvers in the monetary policy to a more large-scale, big-picture strategic framework. And I think that starts in August.
Is there anything this market could do, though, whether it be wealth effect concerns, the bond market just running away from them, that would make an emergency cut make sense to you?
No. Really, no. Not a 4.3% unemployment rate. What that does is set a precedent that I don't think the Fed wants to deliver. Are we saying that every time that we see an unemployment rate below 4.5%, the Fed is going to have to act? Like, what is the framework? Maybe if there's a strategy around that, a long-term perspective that we can reference, but if it's just a 0.2% move in a statistical estimate, then the Fed is really backed into a corner as you look out over the course of next year when we know economic growth is slowing.
Anita, this was great. It's just fantastic to catch up with you. Just a cool, calm head of what's happening right now in the labour market, what the Fed may or may not do in the future. The brilliant Neela Richardson there of ADP. Danny, this reflects what we heard from Neil Dutta as well over at Renmac. They've stepped on a nail, not a bed of nails. And the response to this is an interest rate reduction, and you'll get that interest rate reduction in September. Neil's view.
You could even argue that in Wednesday, in their Fed decision, we have to remember that just cutting rates is not the only easing tool that they have. Even just Powell sounding more dovish was enough to get rates to where they are at this moment with the help of some of a sell-off of 3.8%. You could argue that some easing has already been put in this market. They don't need to do an emergency meeting cut. Maybe they just need to sound really dovish at Jackson Hole, and that's enough.
The schedule for Fed speak over the next few weeks is pretty light. I imagine there will be some speeches scheduled between now and the end of the close in the market. We'll see. Coming up next, Sarah Hunt of Alpine Saxon Woods, Ed Yardeni of Yardeni Research, Claudia Sam of New Century Advisors, who's become incredibly famous, popular over the last couple of days. We'll talk to Sam about the Sam rule, and Ed Al-Husseini of Columbia Threadneedle. All of that still to come. The second hour of Bloomberg Surveillance up next.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, They value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
I'm hearing the market scream two things: growth scare, policy mistake. The Fed may be late.
The Fed needs to get going soon, just given that we have seen, I think, some market deterioration in the jobs market.
What we do know is that when momentum slows, it slows quite quickly.
Certainly there's a signal that September will be the first cut, but I think the Fed will still move very cautiously.
I don't understand the let's go really slowly. If the economy is back to normal, get monetary policy to normal quickly.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, live from New York City this morning. Good morning, good morning. If you were in this market, you haven't had much of a weekend after Friday. At 8:30 Eastern Time, payrolls dropped and quite literally dropped. A big downside surprise in a payrolls report. That upset a lot of people, and now we've got some big calls. 50 basis point cut in September. Citi's Andrew Holmhorst. 50 basis point cut in September. Mike Ferroli of JP Morgan. What a difference a payrolls report makes. Check out the price action. The negative follow-through is real. Equity futures on the S&P down by 2.7%. On the NASDAQ, we're down by 4. On the Russell, we're down by 4.4. Dig into the NASDAQ. Some of the biggest tech players on the planet dropping aggressively. Big moves on Apple, on Nvidia, on Microsoft. Nvidia right now down by 8.8%. On Apple, we're down 7.5%. The big bull on Wall Street, the poster child for some of these tech AI names. Dan Ives of Wedbush, he joins us a little bit later this morning. Danny Berger, he says this: we're getting inbounds from investors around the world throughout the weekend, asking us if this tech bull market and historic run for tech stocks is over. He says it's not. We view this as just another white-knuckle moment in a multi-year bull run for tech stocks that need hand-holding.
So no black suit for Dan Ives yet. We're not quite there. But you got to talk about timelines here. If you're talking about the short term, it's really hard to step out in front of this when you have so many people who are long year to date, and you have all of this short volatility trades that have been put on. It's like picking up pennies in front of a steamroller. The steamroller has arrived by all accounts, and it is painful when it does. The question will be how much longer it lasts.
As we get to this bond market, set up the board, 2-year, 10-year, 30-year, and let's just look at the difference between the 2-year and the 10-year. Just in a commercial break, Danny jumped all over this bond market and said, look, we're within 1 basis point of that yield curve disinverting. The 2-year right now at 375.81, the 10-year, Danny, at 374.35.
My favorite thing about this is all those people who said, look, when the yield curve starts disinverting, that's when you get recession. And everybody who's coming out now and saying, see, look, I was right, it's happening. There's some confirmation bias happening in this market because the data hasn't been that bad. The signal that this bond market is giving us that there's an emergency cut coming, that they're going to have to step in. Neil Richardson was just saying it. If the Fed is going to do that, what are we doing here? What sort of framework are they working with that just 4.3% in unemployment would mean an emergency cut? That surely would confuse many people.
This is an aggressive bull steepener. It's a continuation of what we saw in July, a 50 basis point move in July, 2-year yield lower. Just last week, 50 basis point move lower, again on a 2-year yield. On a 2-year right now, aggressively lower compared to where we were only a few weeks ago. So how does that set us up in foreign exchange? It means a ripper of a rally in a Japanese yen. Dollar yen is down to 142.55, a massive move there. In Japanese equities, a 12.4% move on the Nikkei 225, the worst day of losses in Japan that we've seen going back to 1987. So will things settle down? What's the circuit breaker for this? A Fed speech a little bit later or some economic data? Let's talk about the week ahead. We've circled two things for you here. One is the ISM Services Index a little bit later this morning, 10 a.m. Eastern Time. The other is jobless claims on Thursday. If this sell-off, if these moves are all about the data between Thursday and Friday, ISM manufacturing, jobless claims and payrolls, can we settle things down, Danny, if you get a decent read on ISM Services? And what happens to this market if we don't?
I am scared for what happens if something is weaker. Again, just because so much of this feels to be a liquidity squeeze, I'm questioning how much of stronger data could really stop it. John, you'd have to hope it stops it somewhat. But again, if a lot of this is yen appreciation, hurting the tech trade, a more mechanical type sell-off, it's unlikely that strong data on its own can be the circuit breaker.
Look out for that data a little bit later this morning. Here's the lineup for you over the next hour. We'll catch up with Sarah Hunt of Alpine Saxon Woods. As this market sell-off continues, we'll speak to Claudia Salm of New Century Advisors on the Salm rule. Look out for that conversation later this hour. And Ed Al-Husseini of Columbia Threadneedles as traders ramp up bets on an emergency Fed rate cut, which I have to say a lot of guests this morning, so far this morning, pouring some freezing cold water over the prospect of that actually happening. Let's kick it off with our top story. Global stocks selling off on concerns that the Fed is behind the curve. Sarah Hunt of Alpine Saxon Woods writing this. The totality of the data seems to have shifted, and that was a certainty last week. Sticking the soft landing now is being called into question. Sarah joins us now for more. Sarah, good morning to you.
Good morning.
What changed at 8:30 Eastern Time on Friday morning?
I think it started to change on Thursday, and Friday just confirmed the fact that the data was in fact getting weaker. Those ISM numbers were weak on the manufacturing side, and then you had a payrolls report that was much weaker than people expected. And there's been a lot of controversy on the payrolls report of how easy is it to interpret the data and whether or not the birth-death model makes a lot of difference. And when the numbers were high, nobody worried. And now that the numbers are coming down, people are really starting to worry, and you start to hear that conversation again, like how strong was it really all year and how strong is employment? And I think that that's part of the problem that you're having, and it just reinforced the fact that you had weak ISM numbers.
Let's chop up the equity market. 7% move lower almost on small caps last week. Financials got battered on Friday. Tech's getting hammered this morning. Banks are down again. Is there anything about these moves that you want to pick up the pieces anywhere at all?
I think the place that most people are going to want to pick up the pieces is going to be technology, because I think you had a guest on earlier this morning that made the point that the small cap trade and the bank trade didn't make a lot of sense if you thought the economy was going to get weaker. So I would say that that also is true, and that was one of those what else can we buy trades, as opposed to we really need to be in these sectors right now. I think that some of what's happening in tech is just you haven't really had a correction in a long time. You had this market running right up from January to July, and then we did a complete U-turn. So I think that that's where people are going to want to be. To Dan Ives' point, I don't think it's the end of the world, but it certainly is a very fast correction and a very strong correction when people were not necessarily expecting this much drama. But you have so much that's happening on an unwind of the carry trade, to your point on the end. There's so many different mechanical pieces underneath that it's hard to parse them all out because they're not obvious. It's not one thing, like earnings were terrible. They weren't. They were okay. It's just a lot of different pieces.
But I wonder, even if tech is the trade, is some of that huge enthusiasm we had over AI, is that just done in a market where you need to worry about whether the Fed is going to cut or not? Can you really be so hopeful on giving those companies more time to let their AI plays play out?
Well, if you think about some of the parallels that people have made to like the 2000s, right? You had a lot of companies in the 2000s that were selling to customers that didn't have any money. So they were financing their own customers. It was a whole different situation than what's happening right now. I think that AI is like dark fiber back then. People are putting in capacity because they're not sure exactly how they're going to use it, but they're pretty sure they're going to find a use for it. Is that as fast as people expect it to be? Probably not. Is it what people expect it to be? It never is. It always changes. So I don't think that that goes away. And the companies that are bankrolling spending on this have a ton of money. It's not like they're in trouble in any way, shape, or form. But the timing was always going to be, Wall Street's so quick, immediate. I need to know immediately what's going to happen. And that's not the way it's playing out. And I think that that's part of what you're seeing here as well.
But even so, when you do see these stocks swing to the upside, the moves are huge. I mean, you get, again, $100 billion plus moves on the upside or on the downside for just a single name like NVIDIA. Does that make it harder just to stomach, to hold on to the ride?
It's one of the reasons why you're not supposed to look at your portfolio every day, right? But we do anyway, because that's what we do for a living. And I think the problem is just you had the law of large numbers with a lot of these tech companies. The earnings moved so fast for NVIDIA in particular because people were scooping up those chips and they were being able to charge higher prices for them. So then the question becomes, okay, when things settle down, what kind of pricing can they get? And AMD all of a sudden is now becoming a player, which people thought that they would be, but that didn't seem to be. And then all of a sudden their earnings were good and they were like, yes, look out for us. So there's a lot of moving parts. And yes, those things swing around a lot.
Let's just sit on the Fed just for a moment. Sure. We'll catch up with Ed Al-Husseini a little bit later this hour. He draws the distinction between a Fed cutting to become less restrictive and a Fed cutting to become accommodative. And I'm trying to work out where we're going to be in September. Are we cutting to normalize, or are we cutting to address a growth shock? Because they're two very different things. And I just wonder how different your capital allocation decisions would be based on what kind of decision we actually get in September.
Well, that's part of the U-turn, right? And that's part of, if the Fed had cut last week, which I would argue that they should have at least 25 basis points, then I think the amplitude of this would have been lower. You still would have had a directional downtrend, but I don't know if the amplitude would have been so high. And I think part of the problem is that's what they were moving towards, which is cutting to normalize. And now the growth scare is making that shift to maybe they're cutting because they have to. And that's where the 50 basis points, I think, is a push, because I don't think that they want to look that worried about it in September. But I think that if there really is a growth scare, I mean, we've been trying to position for slower growth anyway, so it's not like that's going to change our allocation too much. But in the end, this quick turn from markets and perception and investors from it's all fine and we still have growth to, oh my God, the world is coming to an end, is really made all of the markets come down. And I mean, everything is coming down right now. So I think that I don't think people were expecting the amplitude of that change.
Okay, so I'll put it another way. Are these rate cuts worth buying, or rate cuts I should sell?
Oh, that's a tough one too, because I mean, I think that the question about, I was thinking about this in the green room, the question about rate cuts and what happens with rates when people are piling into treasuries as a safety trade, it stops becoming about rates and it starts becoming about safety. So it almost doesn't matter in the near term because people are piling into treasuries because that's someplace to put money. And I don't know when that flips back to, no, we really care about what the Fed's doing, and that's why I'm buying bonds, to I need to buy bonds because they're safe.
You mentioned what would happen if we got a 50 basis point cut. Sarah, if the Fed does do what this market is saying, an intermeeting Fed cut, what would the reaction be?
I think, unfortunately, because they missed the opportunity last week, the reaction to a inter-meeting cut would be, what are they seeing that we don't see? And I think that's what they don't want to do, right? That's what markets don't want to have, is that kind of, 2 weeks ago everything was fine, or a week ago everything was fine, and now you feel like you have to come and intervene, when 25 basis points, to be fair, is not a huge cut. It's just that people were worried that if they went 25, they would expect that they would keep going. And I don't, that kind of concern I don't really understand. I think the Fed has more power than that, but they seem to get trapped into perception, and I think that that's part of the issue.
I just want to make sure I walk away with the right impression of where you're at currently. Do you think the pendulum swung too far in the other direction now?
Absolutely. But
Where
I don't know, but it doesn't.
More so in stocks or in bonds?
Both right now.